an environment in which we expected to see something of a bumpy landing. It didn't come as quickly as we anticipated. And probably there are a lot of folks who expected some kind of landing in 23 that didn't see it. I'm still in the camp that anticipates a bumpy landing in 24 as opposed to a soft landing. I know that's not really the conventional wisdom today, but my view is that we saw so much aggressive tightening, and it was quite synchronized across major Western developed economies. So I don't think we're going to get away with a truly soft landing, but I do think we're going to see a bumpy type of landing in the first half of the year, but it'll be quite brief, and then we can get that out of the way and look towards a reacceleration in the back half.
I love that you went there. I wonder how much of that bumpy landing goes to something that we talked about what global central banks will be doing maybe differently. Maybe Europe has to ease earlier than the United States. So how does that kind of roll into your investment thesis?
Well, I don't think that there's going to be a lot of difference between the central banks in terms of when they start easing. I think the more important takeaway is that they are all going to be easing, and I think it's going to be rather significant this year, especially for the Fed. I'm in the camp of 100 to 150 basis points this year, not because I think the economy is going to deteriorate dramatically, but because Fed officials themselves have admitted that where monetary policy is today is very restrictive. And so if we see a continued disinflation, which I think we will, I think it's going to actually accelerate from here. I think the Fed is going to be forced to cut to just get out of very restrictive territory.
And so, Christina, if we do see all of these big developed market central banks kind of moving in tandem when it comes to the downside, of course, cutting rates in harmony, so to speak, how does that play out in global equity markets? Does that lead to another year where the U.S. is outperforming, or how does the rest of the world shake out?
Well, I think that what we're going to see is probably the Fed cut more than other major central banks. And so what we're likely to see is a continuation of U.S. dollar weakening, and that should be positive for other areas of the world. In particular, what we're likely to see is areas like the European stock market benefit from more exposure to cyclicals, which I think are going to perform better, again, as markets discount a reacceleration. I also think there's a lot of opportunity, and I'm most positive on emerging markets, which I think will also benefit from an easing U.S. dollar.
So, Manus, I did ask about the rest of the world.
You're okay.
I got it in
To
there.
be fair, no, cyclicals are not going to save your life and give you a retirement
Christina,
fund.
we're getting a lot of flack from Manus this morning that we're too U.S.-centric.
Well, something else.
Then Jonathan Ferrer would get on the phone and say, why are you talking about anything else apart from U.S. stocks, Manus? It's a U.S. stock market opening show. Focus on the U.S. stocks, which is fair enough.
I hope he's not watching.
No,
but,
he's walking somewhere very happy and healthy and away from here.
I would imagine so. But, Christina, coming to another debate that we've been having, if you want to call it that, money market funds. There is so much cash in money market funds right now, $6 trillion or so by some estimates. When does that cash come out, if at all? How sticky is that cash, and does it belong to risk assets, or can it stay there?
So I think the big question is, how overweight are investors in money markets? Some exposure makes sense. Let's face it, that's part of being well diversified. But there is a significant overweight on the part of some investors, and I do think that starts to come out. It's interesting because it could very well be something of a perfect storm this year, where we see rates start to go down, so money market looks less attractive as a broadening of the stock market looks more attractive. I also think an important destination for some of that excess money market assets is likely to be longer duration fixed income. In particular, I'm excited about investment grade bonds, but I also see opportunity.
In the U.S.?
Yes, in the U.S., to a lesser extent in Europe, but definitely in the U.S. And I'm also very excited about emerging market debt.
Well, let's just talk about the emerging market, because that's twice that you've mentioned it. If I look at the flow into ETFs in emerging markets, you're looking at $26.5 billion going into equity ETFs. Now, of course, Goldman Sachs have been the mea culpa moment. They said you want to strip out China from emerging markets. So do you strip out China from the emerging market call that you've just made? And do you want to be longer of equity than you are of debt within the EM trade?
No, I don't think you strip out China, although it probably makes sense because it's such a major economy and such a major investment destination to have it as a separate allocation. But when I'm talking about emerging markets, I'm including China in there. I think there's potential there, especially if we see a continued rollout of targeted policies that are stimulative, that address, for example, the property sector. But there's a lot of opportunity outside China as well, especially in Asia EM, that should benefit from an improving Chinese economy, but also have a lot of things in their favor. I mean, if we think about some of the Asia EM countries, demographic trends are really attractive, growing middle class. I mean,
Right.
it's an interesting time. And also valuations look quite attractive.
Hey, Christina, I feel like we'd be remiss. Just 45 seconds. We're watching geopolitics. I'm thinking about politics in the U.S. later this year, the presidential election. Just very quickly, 30 seconds. How are you thinking about that?
Well, I think most investors have a long time horizon, and so they shouldn't let what's going on, the headlines, which can sometimes be concerning and disturbing, to take them away from a long-term investment plan that's well diversified. Yes, we're likely to see gyrations that are more short-term in nature, but for most with long time horizons, it's really all about being well diversified and putting on political blinders.
Okay, we got the blinders on, Christina. We are agnostic. Christina Hooper there at Invesco with her calls on the equity markets. And of course, that is in part tied to how much rate cuts you get. She's in the market for 100 to 150. Let's check the markets at the moment. S&P 500 still desperately trying to get a new record high, 47.77. Now turning into the green by 0.5%. So we have that little...
Desperate? Is it really desperate? It looks kind of limp there.
Wow.
Feels tired.
Depends where you are. No, you got to reinvigorate yourselves. I mean, you've got to actually get, your job here is to make these things come alive.
And I'm saying it would be so excited if we were absolutely unchanged for the first time.
I believe you.
Since 2017.
I can see you're going to get it on your phone. It's going to be on your social feed.
I'm just waiting
right
to
there.
tweet that out, man.
I think what is surprising is that oil is giving back nearly 1%.
Yeah, agreed.
As I've said to you, both of you, I'm very surprised that you don't have more of a war premium in there. In total, in the past 7 trading days, you're looking at a 5% rally, and 5% rally does not constitute any kind of war escalation premium, even though you have ignited more attacks in the Red Sea. You've got U.S. activity in Iraq. We've had EDNF man here this morning saying oil is cheap. And don't forget, the U.S. is refilling the SP ore at these kind of levels.
In a green world and climate change very much front and center, it just feels like we are awash when it comes to energy and hydrocarbons. Like, it just feels like that, it's just kind of interesting to see some of these numbers.
Being awash in oil, not necessarily a great thing. But when it comes to the war premium, I mean, you think about when we peaked, at least for this year, really came right around at the end of September. Really, since we've seen the Israel-Hamas war break out, it's just been a leg lower for oil.
And that's where OPEC Plus, the Saudis in the first instance, along with the Russians, were, one could say, well, the phrase is preemptive, proactive, protective actions by the OPEC Plus members, and that's when they extended their unilateral cuts to the end of December. We then had an OPEC Plus meeting where they went further.
A lot of conversations going on. India's Prime Minister Modi talking to the Saudi Crown Prince after that oil vessel attack. There are a lot of conversations going on around the world because everybody's watching it.
And this is about the coalition of strength in the Red Sea to protect 12%. I think that's the number that you said, Carol. 12% of global trade going through the Red Sea. That is your risk this morning. Coming up with the team, Bill Northey of U.S. Bank Wealth Management joins us next.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Washington, D.C. has decided that they're going to run this U.S. economy at full employment at all cost, which means it's going to be very difficult to get the consumer to pull back. I do believe 2024 is going to be the year that we have a very serious discussion in the financial markets about the Federal Reserve's credibility as an independent entity.
That was Tom Zizorius, Strategas head of fixed income research on the credibility of the Federal Reserve going into 2024. It's going to be an election year. The market presumes 150 basis points. Do they front load those? This is going to be the slightly more interesting nuance. We've had various guests this morning saying they think the Fed will go first and be more aggressive in the front loading their rate cuts relative to the ECB, relative to the UK. The question is, of course, who's going to be bounced into that most aggressively and first, and that is the debate.
Well, especially when you have some guests coming on and saying, well, maybe it doesn't start till maybe June or July. You've got a meeting in both of those months. Is September 20th off the table because it's getting too close? November 1st, absolutely off the table. So how do you think about it?
Well, I'll steal a thought from Lisa Abramowitz. Last week, she made the point.
I believe it's the Queen, because she's like incredible.
The Queen of surveillance. Does it
She's
matter
like
if they go in March or April or June? Does it really matter? Of course, I know that the market and all of us are really going to twist ourselves in knots trying to debate that, but at the end of the day.
It probably does. I mean, just think how we twisted ourselves up in knots over whether the nuance was pause to pivot. No, it's... Good morning, Lisa. I'm sure she's tuned in. No, she's probably on, somewhere far away enjoying herself.
On the slopes,
On the slopes enjoying herself. But, I think it is. I think we would become myopically obsessed with this again in the same way as we look at every nuance of every Fed speaker. What does it mean? What does it mean from the hawks? What does it mean from the doves in terms of the number of rate cuts that you're going to get?
It's also going to be, right, is it a 25, is it 50? Or, is it, always the concern is, oh, wait, the Fed moved faster, or sooner rather than later. So that means, oh, wait, what are they seeing? Is the economy more problematic here in the United States than we all thought? Is it not maybe the softer landing? I mean, the conversations we're going to have where we kind of just pick apart and parse everything that they say, the Fed officials.
Well, the question is at 384 on 10-year government bond yields. By the way, we have a global bond market rally this morning. You've got German government bonds. You've got UK.
Wait, we have a global bond market rally?
There is a word. There is a word.
Other countries have bonds.
Okay, you two. Okay, this is the Jersey. This is the Jersey girls sort of building up and backlash against a poor Irish guy that just got off the boat.
Oh, please.
You make a good point, though. The yields, they're moving lower.
They are moving lower.
And our guests have said it, right? It's cumulative in terms of what we are seeing from global central banks.
So the question that we'll put to our very first guest, which is Bill Northeast, Senior Investment Director at U.S. Bank Wealth Management, is, do you buy bonds? If so, what allocation do you make to them into 2024? 2024, in theory, will now build up. You can see the headlines. It'll be the year of the bond. It wasn't supposed to end that way. U.S. bonds delivered a 3% return. Can we extend that rally into 2024? Good morning.
Good morning, Madison. You guys are having a lot of fun on set there this morning. So, capital markets clearly respond to a mosaic of factors, but the past 2 years have been dominated by the battle against inflation and interest rates and interest rate expectations. We expect 2024 will be very much the same as we move into a period of time where there's an expectation of a Fed pivot. We've paused. Expectations around rate cuts have now been pulled as early as March of this year. But there remains this differential between capital market expectations and what the Fed has communicated through their summary of economic projections. And it's really that differentiation. 75 basis points is communicated by the Fed, expectation from the markets leaning 150 basis points in rate cuts in total and starting in March that will determine really the path and momentum of broad capital markets as we move into next year. So, specifically as it relates to bonds, most people started 2023 looking at those very juicy cash rates in the front end of the U.S. Treasury curve and thinking, 4 to 5% by the end of the year was something that should populate portfolios. And as we close out 2023, you're looking at potential record close for the S&P 500. Broad diversified portfolios balanced between bonds and stocks have actually produced very, very substantial returns relative to the safe cash return.
All right, so that means, Bill, timing and magnitude do matter in terms of those interest rate cuts. Having said that, would you advise investors to kind of wait before shifting around in their portfolio because we're not quite sure about the timing and the magnitude?
Well, our expectation has been that we will actually experience this mythical soft landing as we move through the balance of 2023 and into 2024, expecting that the front half of 2024 will likely mark the slowest period of economic expansion here in the United States. But we have to acknowledge there's a lot of risks, and the risk of a technical recession is a non-zero probability as we move through the first half of next year. So against that backdrop, we recognize there's opportunities, expectations for corporate earnings growing next year, albeit estimates might be a bit high at this point. But continued expansion, and that leaves us in a fairly neutral allocation with respect to how we're positioning portfolios against investor long-term goals and investment policy statements. So meaning equal weight equities at the headline, equal weight fixed income at the headlines, and we'll look for that next fat pitch to make a tactical allocation away, depending on the evolution of data. And that data can come in the form of certainly monetary policy as it reacts to the progression of inflation.
What is a non-zero probability? I'm sorry, I love statistics, got really into it, but what is a non-zero probability?
Well, our base case is for a soft landing, meaning that we expect our U.S. Bank Economics Group is expecting that we'll have something north of 1% growth as we move through the first half of next year into the second half. But we have to acknowledge that there are a whole host of potential risk factors that exist. As you were moving through your prior segments, you noted some of the geopolitical instability that exists around the globe. We're moving into an election cycle here in the United States, and there's a significant amount of lagged effect of monetary policy that has yet to be digested by our own economy, and monetary policy impacts around the globe that are yet to be fully digested by global economic circumstances. And so we have to respect the fact that there is a probability, and whether we put 10% on that or 20% on that, that we might have some small degree of contraction in the front half of the year.
Okay, so it sounds like a tail risk. I think we can leave it at that. But let's go back to how you position a portfolio around that. You said that you're at a pretty neutral positioning right now. What would you need to see to notch that up to maybe your risk appetite is back to normal?
Well, some of that really depends on how we arrive at the next set of rate cuts that will really be the primary factor that drive capital markets next year. If it's purely a function of inflation remaining under control and the Federal Reserve able to move back to a neutral rate, that's probably sets up very well for risk assets, allows corporate earnings to grow, and it may not ultimately manifest in the full 150 basis points of rate cuts. If, on the other hand, they must go 150 basis points or more based on economic weakness, that probably sets up for a more challenging set of economic circumstances and corporate earnings environment that will impair fundamentals. So as we think about that in portfolio positioning, last year, or I guess currently this year, 2023, has been a very narrow leadership year, as we've talked about really through the course of this year. But as we
Bill, I'm curious to know, we're in the last minute of the show, and we're curious. We've been debating all week in terms of the money market funds, the residual funds that are there. What level of cash do you have, and are you prepared to draw down the cash and deliberately invest it ahead of the rate cuts in the first quarter?
From an asset allocation standpoint, we keep cash at a relatively low level, but we acknowledge that clients, whether that's institutions or individuals, are holding a very significant amount of cash. And we would recommend that people begin to deploy that cash into longer-term investment opportunities in a balanced portfolio. So equities, fixed income, real assets. We believe that full investment will serve investors well as they move into the next calendar year.
Bill, thank you so much. Succinct and to the point there. Bill Northey of US Bank Wealth Management. Deploy your cash ahead of those potential rate cuts that are coming down the pike in theory. And if it was this year that you were involved in these markets, you wanted retail tech really in your performance in the S&P 500. But tomorrow we've got a pretty important conversation coming up on Bloomberg Surveillance, 7:30 a.m. Kathy Wood, founder and CEO of ARK Investment. She'll join the Jersey Girls and myself. So what's going to be the top of the agenda there, do you think?
I mean, her performance has been pretty incredible.
Yeah.
Haven't seen the flows to match it in China. What we've been talking about all morning.
China, Tesla, her thoughts on Fed. She's had some really strong thoughts for a long time. So there's so much we're going to cover.
Yeah, and if you want an EV, do you want a Tesla? Or do you just want an alternative? That's the question. Are you an evangelist of Tesla? We'll ask Kathy those questions tomorrow from the team here in New York. A very good morning.
The annual prize money pool in LPGA tournaments has grown 50% since 2019. In 2023, it topped $100 million. But the prize fund still lags far behind what men compete for on the PGA Tour. The inequality hits hardest at the lower end of the money list.
Clearly, we want the top players to continue to make a great living playing. These are the very best in the world. But we also then dig in and say, okay, what's the 50th best player in the world making, and what did she make last year? I've asked Kathy to run numbers many times to say, okay, tell me where we are exactly during the middle of the season, at the end of the season.
That 100th player, our goal would be to obviously have that player make considerable amount of prize winnings, and we're going to work really hard to do that. Having said that, we do need to continue to focus on ways to provide opportunities so that 100th best player can cover those costs that it takes for them to be out here on the golf course. That's hiring a caddy, that's travel, that's strength coaches. We're helping to provide stipends for health insurance or create a tour-wide health insurance program. Ability to create more discounts for travel, for hotel and car and all those things that really cost them a lot.
To meet these objectives, LPGA leadership collaborates creatively with sponsors.
We've worked with some of our corporate partners to say, help us solve a problem. Help us create a fund that will allow our players to get to the first tee ready to reach peak performance.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. The island emerging as a flashpoint between the U.S. and China. Taiwan's presidential election is drawing global attention.
Taiwan is an elephant in the room.
After the Biden-Xi Jinping summit,
we had some pretty tough talk.
Bracing for potential war scenario.
As voters head to the polls in January, Bloomberg takes a close look at the candidates, the issues at stake, and what it means for the world. In case you missed it, watch Taiwan Decides, a special report tonight at 9:30 Eastern. Bloomberg, context changes everything. From New York City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg. Top experts. Great questions.
All right, good Wednesday morning from the Bloomberg Radio Studio in New York City to our worldwide audience. Kaylee Lyons and I will be simulcasting on Bloomberg Radio and TV today. How cool is that, Kaylee?
Very cool. Happy to be here, Paul.
Absolutely. Stocks, guess what? They're trading higher this morning. Yields pull back a little bit. The 10-year Treasury yielding about 3.8% on the commodities front. WTI crude oil slightly lower here at about $75 per barrel. Had been moving higher, obviously, on the Mideast concerns. Gold a little bit higher here, $2,070 per ounce. Coming up, we're going to get the latest reporting on holiday retail sales. Plus, we're going to get the market call from Ethan Devitt, Chief Investment Officer at Moneta Group. But first, I think we need to go over to the Red Sea, get the latest reporting on tensions in the Red Sea and its impact on global oil. Brendan Murray joins us here, Bloomberg News reporter out of London. Brendan, I'm seeing a article on the Bloomberg Terminal, Bloomberg News. Hapag-Lloyd, a big global shipper, they're continuing to reroute their ships away from the Red Sea. What's the latest?
Right. Well, there still seems to be the risk of attacks sailing through the Red Sea. The latest was an MSC ship that was attacked yesterday. So Hapag-Lloyd is taking the stance that we're still going to divert around Africa. And not take the shortcut through the Suez Canal, seeing too much risk of doing so. These ships are carrying anywhere from $500 million to a couple $billion in cargo. Not to mention the serious risks to their crews. So many of these big shipping companies are saying it's still too risky to take the chance. So they're making that extra 25% a journey that's 25% longer than it otherwise would be. They're still continuing to make that decision, and the number of ships that are diverting is still rising.
Well, and Brendan, this is despite the U.S.'s efforts through a maritime task force to make sure that merchant vessels are protected, that any drones potentially shot down by or sent by the Houthis would be shot down. So is anyone feeling protected enough to go through the Red Sea right now? Is there any real activity?
Well, we had a statement also from Maersk, which is the #2 global container shipping line, that said they're preparing to resume sailing across the Red Sea as soon as it's appropriate. Now, when that is, we don't know, but at least they're sounding like they're willing to take that trip as soon as they can get assurances that their ships will be secure. That was a turnaround from a week ago when they said they were calling on the U.S. and the U.K. and other countries to provide more protection. So we're seeing a sort of incremental steps back toward the direction of sailing through the Suez again, but still it's not happening on any large scale.
I see, Brendan, from some Bloomberg Intelligence research that spot rates for container shipping have jumped 26% over the past few weeks. Who pays that higher cost?
Well, the cargo owners pay that cost. These get added on, and surcharges and other sort of incremental costs that the shipping lines charge them. Ultimately, the customers of transport services pay those, and they in turn pass those to consumers in one way or the other eventually. So 26% increase is not an enormous spike higher when you look at shipping rates have plunged 75% this year, but it's still a turnaround from the steady erosion of freight rates that we've seen throughout the year, and one that the shipping companies frankly would welcome. They can't really make money at rates the way they were 3 weeks ago, but now they're kind of back in the profit-making zone.
So, Brendan, obviously there's a cost calculation here in terms of what the impact of this waterway, which is so crucial in terms of maritime trade being blocked is, but it also, to your point you were making earlier about the time it takes to go around the coast of Africa instead, is about time, especially when we think about how supply chains were so snarled back during the heart of COVID days. Are we going to see any of that backups in ports as all of these ships are taking longer to arrive at their destinations, or is it likely to be a bit smoother than we experienced a few years ago?
Well, it all depends on how long this lasts. I mean, we're seeing hundreds and hundreds of ships diverting now. Those are all going to be late in their ports of original ports of destination. All that cargo is going to have to be rerouted. New schedules for delivery and pickup with trucks and trains, so we'll see an initial jolt to supply chains. But in truth, supply chains have been pretty resilient. They've absorbed a lot of these, even the biggest shocks. So we'll see some initial disruptions in the coming weeks, and if it gets resolved and shipping continues through the Suez Canal, the likelihood is this won't leave a huge dent on the global economy or global trade more broadly. But initially, it's going to be painful, especially come January when one of the peak shipping seasons of the year happens as retailers look to restock after the holidays.
Brendan, ultimately, who decides when it is safe to transit the Red Sea? Is it the U.S. Navy? Is it the shipping companies themselves? Who decides?
Well, it sounds like the shipping companies themselves are making this decision based in large part on the signals they're getting from the forces in the area. There are a few container ships going through, and as we saw yesterday with the MSC ship, that they're getting attacked by drones and rockets and other things. So the shipping companies, though, are taking their cue from their insurance companies that are saying, "Look, it's too costly for us. It's going to be too. We're going to raise your premium if you want to do that." So there's a trade-off that they're weighing, and ultimately, higher insurance costs will sort of dictate some of those decisions.
All right, Brendan Murray, thanks so much for joining us from London. He is our trade czar here at Bloomberg. I love the czar titles, Paul. Those are the best titles in the building. Another good title, though, is executive editor, and I'm pleased to say our senior executive editor for energy and commodities, Will Kennedy, is joining us now, also from London, to talk through how this is translating into oil markets. It's actually interesting, Will. You had oil closing at the highest level in about a month yesterday. Coming off those levels a touch today, we're now at $80.65 for a barrel of Brent crude. Should we be expecting this to resonate more with the oil market, or are traders just expecting that this is going to be a very short-term impact that ultimately doesn't fundamentally change anything that much?
Good morning, Katie. I think it has had an impact, to be honest. Oil prices are higher than where they were. They've fallen really quite sharply early in December, and they've rallied against this news in the Red Sea. They're still below where they were at the beginning of the fall, when they were close to $100, but they have rallied. I think it does make people nervous. It makes people nervous that the conflicts that we're seeing in the Middle East could spread. Clearly, the Houthi rebels, who are responsible for this attack, are sponsored by Iran, as is Hamas in the Gaza Strip. So that wider regional tension remains, and it does make oil traders nervous. But I think there are a couple of reasons why the reaction perhaps hasn't been stronger. Oil markets remain fairly well supplied globally, and a lot of the oil coming through the Red Sea is destined for it's Russian oil destined for Asia, and it's unlikely that Russian oil perhaps would be a target of these attacks. So there are reasons why that people aren't so nervous about oil tankers in the Red Sea. And finally, Saudi Arabia and its allies in OPEC, especially the Arab Emirates, retain a good amount of spare capacity, which means that if the situation were to worsen, that there are policy responses that OPEC could make. And I think that means that some of the sting of geopolitics on oil prices is removed at the moment.
Will, before this latest flare-up in the Red Sea, oil prices had been trading lower, and WTI crude oil was below 70. Where is the market now in terms of assessing demand here? It appears that the U.S. economy, at least, may be in for a soft landing. Where's the sense of demand over the next 3 to 6 to 12 months?
Yeah, look, I think we should start that conversation, Paul, by talking about demand this year, which has been a lot stronger than many people expected. It rebounded incredibly sharply in China, as China was the last major economy to come out of COVID. It's been very healthy in the United States. As you say, the economy continues to do well, and people continue to to drive, and they continue to demand goods that are transported by truck. I think that demand has been much stronger than many people expected, and if the economy does have that soft landing, there's every reason to expect that demand will continue to be fairly strong. It might not be as strong as it has been this year, because I think that coming out of COVID in China effect was particularly strong. We had that really big snapback. But, you know, we may add more than 1 million barrels a day next year. That's the sort of forecast that people are looking at, and that's a fairly healthy increase in demand by historical standards. So the question then becomes, what happens with supply, and is it more than matched with supply and that balance? But I think you're right to point out, Paul, that as people think about the market next year, that strength in demand is one of the key questions that they're thinking about.
But to your point, Will, about supply, we've obviously learned within the last several weeks that shale this year in the U.S. far exceeded expectations in terms of what they were able to produce in 2023. It's OPEC really that has been more restrictive. The Saudis really the ones leading that, as they would like to keep prices elevated. If indeed that demand picture you're painting does come true in 2024 and you see an uptick in demand, should we expect that OPEC is necessarily going to respond by putting more out there on the market, or are they likely to try to keep things as tight as possible?
So they agreed to cut more in a recent meeting at the beginning of December, and the Saudis themselves were not contributing to that, but other members agreed to pare back production or forego increases that they had already agreed in the case of the United Arab Emirates. I think what that means is that OPEC will want to see that play out in the first quarter. When we last spoke to the Saudi energy minister, he said they were willing to keep those curves in place beyond the first quarter to see demand tighten. So I think when you put that together, they're unlikely to put any more oil in the market in the short term. They really would like to see these cuts work, and they would like to see the market tighten. So they will be patient and wait for that to happen before they think about putting many more oil back into the market.
Despite some of the at least warmer temperatures here in the U.S., we are in peak heating season here. Will, give us a sense of how things are in Europe. Turned out better than expected last winter. What's the situation for this winter?
Yeah, we've had a bit of cold winter. I mean, here in the UK, it's been an incredibly warm, wet, and windy winter, and that kind of weather means that energy supplies are fairly ample for two reasons. One, it doesn't put a huge strain on gas demand because people aren't needing it to heat their homes or heating oil demand. And two, all this wind means that we're generating a huge amount of power through wind. Through the, I think I looked this morning, and the UK was producing more than 60% of its power demand through wind turbines. Wow. So you put that together, and it means that if that weather continues, we should come through this winter in fairly good shape. And in fact, people are fairly confident this winter won't be too bad. There are above average levels of gas supply, and as we say, we haven't had a big cold snap yet. But that could, of course, change. Weather is inherently unpredictable.
All right, Will Kennedy, thank you so much. We appreciate it. Will Kennedy, Senior Managing Editor over there in London, covering all things on the energy front. And again, you think about where the energy prices could go. And last year, there was real concerns in Europe.
Yeah.
And it was just a weaker than, or I guess a warmer than expected winter last year. Plus, they built up their supplies and their inventories to such a level that they were able to do well. And it looks like they're off to a good start here this year, Kaylee.
Yeah, I have to say, it's been pretty mild here, too,
yes,
Paul.
It has.
No white Christmas was had on the East Coast this year. It's going to rain, though, so we
exactly.
have that.
And the Paul Sweeney personal inflation gauge, which is what does it cost me to fill up the car down on the Jersey Shore, about $3 a gallon. So that's pretty good. I mean, that's down dramatically from where we were just, 6 months ago. So.
Absolutely. And that's something, Paul, I usually sit down in Washington, D.C. The Biden administration has been pounding the table on that fact that gas prices are lower. And yet this still is a U.S. president who is not getting credit for that, inflation coming down, or really anything good about the U.S. economy right now.
Yep. So if you have to fill up, the Jersey Shore is the place to do it. S&P 500 absolutely unched on the day. I'll use that term because I know Lisa Bromwitz does not care for it. Unchanged on the markets. This is Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to Bloomberg Markets. We are simulcast today on both Bloomberg Television and radio. I'm Kayleigh Lyons alongside Paul Sweeney on this holiday week, and we have to talk about what's happening in the markets because sure, Paul, it's a holiday week. There's not a lot of people sitting at the trading desk. You and I are working, but I don't know how many others are. We're looking at volume right now on the S&P 500 down 42% from the 20-day average. So that just goes to show you should take today's moves with probably a grain of salt because there's just not a lot of liquidity out there. But we are slightly down on the S&P 500, which is teetering right on the cusp of a record high. It's been a really remarkable year for the equity market. And the question now is, can 2024 deliver anything like what we've seen this year? 24% gain on the S&P. I'm pleased to say joining us now to help us work through that question and others is Ethan Devitt. She's Chief Investment Officer at Moneta Group Investment Advisors. So Ethan, great to see you. Obviously, it's been quite a year. Are we going to be able to do anything like it in 2024?
Quite a year indeed, and I think that's why volumes are so low. People are kind of probably reeling from the volatile ride that 2023 has been, in a positive way, of course. As to 2024, it has to be said there's probably a little bit of borrowing from next year already in those numbers. We saw at the end of 2023 a volley of new reports and forecasts coming out for 24, a little chastened, a little more humble, since many of these forecasters, of course, got it very wrong in 23. And in some cases, their targets have already been met. So if we've already met those targets in terms of treasury yields, or even getting close to those targets on equity levels, then it's fair to say that we're probably going to see a little bit of a pullback in 2024 as probably the exuberance of the end of 23 got ahead of itself.
So, Ethan, let's talk about valuation here. We've had a big move in equities really since kind of the third, fourth week of October. I don't recall earnings going up by a whole lot during that period. How concerned should investors be as they look at 24 about the valuation?
I think the valuation side, with the exception of the Magnificent Seven and big tech, which definitely got ahead of itself. On the valuation side, I think investors can rest a little bit easier. Remember that the earnings were poor, but were generally rewarded because they had beaten expectations. So a lot of the weakness was already factored in. And therefore, they're now expecting a little bit better performance in 2024. So that's looking good. Many of the sectors were entirely overlooked in 23. We've been talking about the concentration in those Magnificent Seven areas like utilities, renewable energy, healthcare, very much overlooked. Maybe a little bit of a pickup towards the end or in healthcare around those obesity drugs. But otherwise, whole sectors that really haven't had that upsurge that we've seen in other equities. So investors can look at rotation into them. That's our base case. There will be rotation into some of those sectors. And overall, we think that the outlook is good. You talked about the feeling of buying the gas at the pump and how it's lower than before. People are feeling less inflation in their pocketbook. The vibe session we've been speaking about, this disconnect between economic data and how we felt. Maybe that's starting to be eliminated now, that people are starting to feel a little bit more optimistic. And certainly on the back of a positive performance in a portfolio in 23, it's natural for there to be some optimism.
Well, the Fed's probably feeling a little bit more optimistic about its inflation fight as well, considering the way the data has gone and the suggestion that, yeah, they're probably going to start cutting rates at some point next year. It's just a question of when and perhaps by how much. Ethan, what do you think about that, and how does that factor into the rotation you're expecting in equities? What kind of landing does that assume?
Yeah, definitely more of the soft landing is the base case. It has to be. And whether there's any landing at all, we had that no landing scenario even being touted. Certainly that seems to have been orchestrated, that we've now got a little bit of exuberance taken out of the economy. And there's a lot of ammunition in the tank now that the Fed has. Remember, on the fiscal side, there's not a ton of ammunition, not a lot of tax cuts possible. Of course, there will be incentives in this election year, but where there is a lot of movement possible is on the monetary side. So the Fed has a lot of flexibility. That's going to be one of the watchwords for 2024. And now as we look at where their flexibility can start to be flexed, I would suggest it's going to be around the middle of the year, but they have that now, that ability, and we can see the unemployment numbers that will be in focus. The inflation number will be in focus. They said they'll be data-driven. So I would see that they have the ability to move rates around about either the second quarter or into the second half.
Ethan, one of the ways that investors assess the health of a market is the breadth. How many stocks are actually participating in a move one way or the other? And up until I don't know, August and maybe even September, it wasn't very good. It was that Magnificent Seven, but it seems to have improved during the last several months. Do you expect that to continue in 2024?
Definitely, and that's going to be a little bit of the disconnect that investors are going to feel right now. They're going to look at their portfolios. They're going to look at the top line level on the NASDAQ up around 40%. You mentioned the S&P up around 24%. They may not have experienced that in their portfolios because most portfolios are balanced between value and growth. Most will have a balance of small, mid-cap, and large-cap stocks. Small and mid-cap stocks barely participated in that rally at all, and they were very much lagging. International stocks, they did participate to a degree in Europe. Asia was pretty poor with the exception of Japan. So investors are going to be feeling a little bit mixed in terms of that they won't see those headline numbers in their portfolio. But you're absolutely right. We do expect to see more breadth in the markets, and we have seen that in the last quarter. That is a sign of maturing and of this rally getting some legs. And of course, let's not forget, we have the yields coming down, so bonds are a less attractive alternative. And we have all of that money in money market funds well north of 5 trillion now. I've heard it's approaching 7. That money has to go somewhere.
Okay, so even you expect that more cash is going to be coming off the sidelines after maybe people feel like they've been missing out on the gains of this year?
Absolutely. We did see a lot of tax loss harvesting around the end of 23. I don't think we've seen that volume in some time. That will be, of course, some of the losses that were incurred in 22. So, of course, tax loss harvesting means selling. So there will have been that building up of cash. And we only have to look as an indicator at the movement in Bitcoin and as well as gold and other charge risk assets at the end of 23, just to see how that appetite for risk was starting to pick up. I get back to sentiment. Sentiment is starting to improve. All of that will bolster a desire for risk assets. And when cash is not as attractive in relative terms, there will have to be a home for that cash.
And even in the fixed income space, after an absolutely disastrous 2022, I see green across my screen across the fixed income space here, led by high yield in the U.S., which was up about 13%. What's the outlook for 2024 in fixed income? Should I keep that kind of allocation to fixed income next year?
Absolutely. It has been, throughout 2023, a very reasonable place to put money. Cash itself has been very reasonable to put money, and high yield. All of those spreads have started to look really attractive. And the one, perhaps, wrinkle underlying all of that is the default rate. There was that question as to why the default rate was so low. When there was a default, why recovery rates were going to be quite low as well. But ultimately, the default rate had not matched expectations. So there is a suggestion that that could be a little bit of a delayed factor. And we can see a little bit more of that working its way across the system. But overall, I'd suggest that fixed income does make sense, although let's be realistic. We no longer have to deduct the inflation from that. So on a real basis, it's looking a little bit more attractive. Inflation is still there, but not as high. But realistically, compared to equities, is it going to stack up? So I'd suggest, yes, it makes sense, but be realistic as to how much to allocate to bonds.
Ethan, you mentioned there the delay factor, and this is something we've heard the Federal Reserve talking about, this idea that they aren't exactly sure when the full effects of their tighter monetary policy will kick in. The tightening is going to be ongoing, even if the hikes maybe have stopped. Do you think that's appreciated, this idea that there actually may be a lot more that has yet to hit the economy for a market that is looking incredibly optimistic?
That's an excellent question. We've been watching that transmission effect all year. It has been delayed quite notably. Now, I suppose the question is both on consumers and on corporates. On the consumer side, it would be refinancing of mortgages. And of course, selling a house or actually getting a new mortgage. That would be affected by higher rates. Mortgages are already starting to tick down on the basis of Fed expectations. But perhaps that transmission effect may have worked its way out. Where it's not clear is on the side of corporates when they have debt coming due. Will they be able to refinance at levels that are meaningful, basically available to them? And will they be able to support themselves on those new cash flows that are based on higher interest payments? That's a big question mark. I do think, though, that there's a facility to pull through with this with corporates. We've seen the private credit landscape really expand to match those needs as the banks have pulled back. And I suggest also that with rates coming down, a little more stability, the banks are going to do better, which enables them to make more loans. So I'd say overall, we're going to see a transmission effect, but it's going to be a bit watered down.
All right, Ethan, thanks so much for joining us. Really appreciate it. As always, Ethan Devitt, Chief Investment Officer at Moneta Group. Thinking about the mortgage rates, when I bought my Jersey Shore place a while ago, I took a 6% mortgage. I felt like a total knucklehead. But then it went up close to 8%. So I said, gee, maybe I'm a real estate mogul. Now the mortgage rates are coming back down, as Ethan said. So we'll have to
I
see
need them
where
to
that
come
goes.
down a little bit more, Paul.
Yes, I know. I think a lot of real estate folks are saying, I need a 5 handle there. All right, coming up, we're going to get a read on the housing market with Kate Kaminsky. She's a Walton Global Chief Operating Officer. That's coming up next. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Boy, we've been talking a lot of real estate, residential real estate here in the studio. We've got one person who's the point in their life where they're net sellers, and another person, Kaylee, was in time of her life a net buyer. And you think those two people can get together and form a market here, but we just haven't seen much really in terms of inventory trading. So it's really been a frustrating time for buyers and sellers with the rates that were so high earlier this year, another issue. So we're going to delve deep into that. We want to listen to an interview we did recently. Mark Rayfield, Saint-Gobain, North America. He joins us. Let's take a listen.
I think last time we were here, the rates were going up, and there was a question if it went up another half a point, what would happen? And we really believe that because the environment's underbuilt, we talk about a rate of about 1.7 million to meet existing demand per year, and anywhere between 17 to 20 million underbuilt over the next decade. So there is this demand. So rates going down will create, I guess, more people selling their homes and more into the marketplace and more R&R activity. But I think regardless, we've seen today that even with high rates, you see good demand. If interest rates go down a little bit, people feel, 8 was bad, 5 looks good.
So it's really about getting sellers to want to sell.
That would help rotating the market. When you talk affordability, I think when sellers start selling, you get more homes in the market. Right now, you have a lot of new build.
Is that 5%? Is it 4%? Remember, let's just say again, I have a 2.75% 30-year.
Yeah.
I mean, it's going to take a lot for me to, maybe a 4 handle, I'd think about it.
It's true. But I think, again, this is my perception that if you're going into the housing market and you're looking at a rate of 8, and you used to be at a 3, now a 5 looks reasonable. So that will get people maybe getting mortgages and be able to get into the housing market. We see 2 big dynamics. I think about 40% of the homes are all cash owned now, no mortgage. And those people are selling and downsizing. So they're folks, my age or a little bit older, retiring and downsizing. And so that's having a big impact. And we see the highest percentage of new build as part of the new homes right now because people aren't trading homes. So the new build, the big builders, you saw their stocks are way up, are building new homes, which is great for our business because that's building materials.
Mark, Brad Jacobs was sitting in the chair that you're sitting in right now a few days back. He just announced that he's going to be looking to consolidate the building materials distribution business in America and to a certain extent in Europe. One of the things that he was talking about is the application of technology to that business. He thinks that you could see significant technological improvement just in terms of warehousing and distribution and management and all that kind of stuff. How ripe is that industry, is your industry, for that kind of improvement?
I think right now we sell through distribution. We have a lot of very, very good and large distributors we sell through, and they have a lot of technology. They have the ability for their contractors to measure a house, to use drones to take the measurements of the roof, to order directly from that activity. So there's a lot of technology in there. It's also a very hands-on business, distribution. So you have to deliver the products to the roof if it's shingles, into the building if it's gypsum in that area. So it's a complicated market. There's always a chance for consolidation, but I think the existing players in the market are very strong.
Where could things be improved on that end?
I think where we try to improve and where there's always an opportunity to improve is training of the trades. So, if housing continues to pick up, we always say that it's a great career to be in construction products, to be in the construction industry. We need to train more people, and I think it's ourselves and distributors' responsibility to do that.
That was part of a conversation with Mark Rayfield, Saint-Gobain North America President and CEO, last week on Bloomberg Markets. We want to get more insight into the housing market now. I'm pleased to say joining us is Kate Kaminsky. She's Chief Operating Officer for Walton Global. Kate, thank you so much for being here. I want to return to a point of conversation you heard there between Mark and our very own Alex Steele, this idea of where sellers are going to be willing to let go. What rate will get them to actually sell and therefore bring inventory back on the market? And is there an equilibrium between what that figure is and the figure in which demand will also be unleashed?
Thanks for having me on this morning. We're definitely seeing, trends with builders cutting prices of homes that continued in December. About 36% of builders cut home prices in order to really drive traffic into those homes. We're seeing mortgage rates continuing to drop. We're at about 6.7% as of the 21st, and we really think that as we continue to see that trend down to about 5%, that we're going to see more and more demand going into these new home sales.
So, the bad news when I look at mortgage rates is when I look at the MBA 30-year fixed rate, it's 6.83% today. That's the bad news. The good news is it's down pretty significantly from 7.9% just a couple of months ago. So rates are coming down here. One of the questions I have is, isn't there a pent-up supply out there? I mean, people haven't left their homes in terms of selling them really for several years now. I mean, I would think that there's going to be this huge supply coming on the market. Is that what you're hearing at the local market, or is it still demand well in excess of supply?
Still demand well in excess of supply. I mean, in 22 alone, there was more than 80 million millennials that between the ages of 22 and 39 that we're coming into household formation years. So you have that along with your older demographics who are looking to downsize their homes, moving into some of those southern warmer climates. We continue to see a significant amount of demand within the new home building space because of that lock-in effect that we're seeing in the resale market. And so from a new home construction standpoint, the demand is quite significant because that's really where you're seeing affordability. But also that resale market, we continue to see prices inch up a bit, and as a result, the demand for these new households that are forming continues to climb.
Yeah, Kate, you couldn't see us, but when you were talking about the millennial household formation, I was raising my hand, and Paul raised his hand for the downsizing thing. So you have both examples of both groups sitting here in our radio studio. To your point, though, about how it really has been kind of a tale of two markets. On the one hand, existing home sales obviously very choked up because those sellers don't want to let go. New home sales has been a very different story, and I wonder if you think that's going to start to normalize. Will existing then therefore start to be stronger than new, or is it still going to be a new home sales story going forward, do you think?
I definitely think it's a new home sales story for a while. We saw new housing permits up 18% month over month. So I know we're hearing a lot in the market about things softening, and you know, winter months tend to be seasonally slow. This is not uncommon, but builders are also driving incentives to get people into new homes, and so if you actually look at the numbers where we're at year over year, we're up over 1% from where we were at last year. So while we might be seeing some seasonally adjusted numbers that are a little bit lower, home builder sentiment in December was up for the first time in a number of months, which I think is really a result of what we're seeing with comments from the Fed, where we think rates are going, and as a result, I think we're going to continue to see a really strong new home sales market.
All right, Kate, you're in Scottsdale, Arizona. I mean, the hottest of hot kind of real estate markets, literally and figuratively. What are the builders building out there? Are they building starter homes so some young folks can get housing, or are they just putting up the McMansions because that's where the margin is?
Definitely not McMansions. We are seeing those entry level and first move up homes continue to drive market share out here. Really, affordability is the name of the game. If you couple that with the buy down of mortgage rates, you're really able to get people into a home that they can afford, and that is the significant supply shortage that we're seeing in this market and right across the country. And so as the builders continue to strive to work with a company like Walton to find land that is really in the path of growth, where we can put the right pricing on that land and then build an affordable home, we believe that we can get your Americans into those homes.
Well, as we talk about land, I usually am in the D.C. area. Northern Virginia is pretty much as packed as it can get. I would love to have a new home or to build one, but I'm not really sure where I would do it unless you go out toward the mountains. Is that another hot area? Where else other than Scottsdale, as Paul mentioned, are you seeing that kind of activity and, frankly, just the opportunity for that kind of growth?
The Midwest is really leading right now in terms of increases in volume year over year. But your Southeast markets and Texas also continue to be leading markets. Florida, the Carolinas, Georgia, and really right through the state of Texas. I mean, those are markets that for us that we're putting significant volumes under contract and really where you're seeing that most substantial affordability. But you do continue to see demand within areas that have significant population population and job growth. And so, those are really the leading indicators that we're focusing on in terms of where we're looking to buy new assets.
Kate, I'm keeping my powder dry because I want to short Miami. I want to short South Florida real estate. I mean, the move down to South Florida has been unlike anything I've ever seen. It's just extraordinary. And it's not just snowbirds, it's businesses and just whole, it just seems like whole cities are moving down to South Florida. What's the feeling down there from a real estate perspective? Is it a bubble? If so, is it ready to pop? How healthy is that market?
Well, you continue to see significant job growth coupled with the net domestic migration to Florida. It's just astounding. And so while Miami might be really increasing from your average home price, markets like Tampa, Orlando, especially Jacksonville, are really leading in our opinion in terms of affordability and new starts and permits because of that affordability. I mean, we have communities where the builders that we're partnering with are delivering homes that are going to be sub 200,000. And as I said earlier, that continues to be a key driver in terms of where you're going to see these new home builders really focusing on new construction.
Well, Kate, as we talk about the kind of move to Florida we saw, I feel like that really picked up full steam ahead during COVID. Everybody was like, all right, I can work from home. I'm moving to warmer temperatures, just a better climate. It feels like the work from home thing, though, is unwinding. A lot more businesses are demanding that people be back in the office, and that has to affect where people want to live, right? How far out they're willing to go. Are you seeing that?
I think we're really going to continue to see a bit of a hybrid approach. I think that, people definitely are looking for work that offers them the flexibility of working from home and the ability to go into the office. The commercial market continues to be down, especially in Arizona and other markets. And so I don't know that, we're going to see that rush back to the office space anytime soon. But really that desire for flexibility and the ability to have a hybrid approach. And so I think that that's definitely going to play a part in people continuing to look for homes that offer them maybe an office, a little bit of extra space whereby they can work from home and do so comfortably.
All right, Kate, thanks so much for joining us. Really appreciate it. Kate Kaminsky, she's the Chief Operating Officer at Walton Global, talking a little bit of residential real estate. So you're in the D.C. area, Kaylee.
Yeah.
Realistically, how far out do you have to go?
To build a house?
Or just to find, I don't know, a reasonable place to live and not have a deadly commute.
You're looking like an
hour-long
hour-long commute. We got bad traffic.
We've got bad traffic there.
And the alternate transport system just isn't like it is here in New York. You don't have the nice trains. It's just metro and... it's not great. The outlook is not great, Paul. I'm feeling better than I was.
Yeah, well, I have a 2-hour commute. Mine's south. I found out Caroline Hyde goes about the same distance north of here. So, I mean, talking about some people doing some commutes here. But anyway, a lot of good stuff coming up. Stacey Widlitz, she's going to join us. She's of South SW Retail Advisors. Get a sense of how this holiday retail sales season is playing out for retailers. I spent my money. This is Bloomberg.
What did you learn in the last 40 years about leadership in politics?
Well, I've been learning a lot about leadership for a very long time, observing it in others, recognizing what is needed to get the job done. And I always define it in this way: know your why. You have to know why you're doing this, because you will be under attack, this for sure. Know your why, know what you're talking about, know how to get it done, think in a strategic way, and then that's all up here. And then also connect directly with people. If you can show them how important what you're advocating is and what you know you're talking about, so they trust your judgment, and you have a plan, you will have followers. You will be a leader.
of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Welcome back to Bloomberg Markets. We are simulcast on both TV and radio today. I'm Kaylee Lines alongside Paul Sweeney on this holiday week. Paul, Christmas is over.
Yep.
Is shopping season over now too, or are you hitting after Christmas sales?
I don't know. I was, I'm done, and I don't know what happens for regular people though.
Yeah, I think I might be done too.
All right, let's bring in Stacey Woodlands. She's a president of SW Retail Advisors. Stacey, thanks so much for joining us here via Zoom here. Can you give us a kind of a rundown on how this 23 holiday season is kind of shaping up?
Sure. So what we've seen so far is, every year the sales, the promotions get earlier and earlier, and this year was no exception. And we had a longer in between Thanksgiving and Christmas, so there was like a deeper thud. But generally this year, inventories are really well controlled, and that's the good news, because last year we were way over inventoried after COVID and nobody knew how to gauge demand. So generally promotions were a disappointment this season, and that's good for operating margins. It's a little bad for the customer. So I think what customers did is they shopped around the Black Friday, Cyber Monday holiday, and those were the best deals out there, hands down. Since then, it's been, full price selling, high margin selling. So, sales were probably not as great as we thought. The MasterCard numbers are out a little light. And of course, consumers are still spending on things like restaurants and going out to dinner, which were up 8% in the numbers. So that's eating into some of the things and the goods that we're all expected to buy over the past 6 weeks.
Yeah, Stacey, I think you're referring to the MasterCard spending pulse data that came out yesterday. It actually showed that holiday sales rose at a slower pace than in 2022. When you take retail sales, X out autos, increased 3.1% from November 1st through December 24th versus a year earlier. For comparison, a similar study in 2022, that was up 7.6%, which is really interesting. To go back to your inventories point, though, we can talk a lot about the consumer and what it is they are demanding and what it is they aren't. But when we're thinking about inventories, you mentioned how they were really oversupplied last year after being short supplied the year before that because of supply chain issues. Are you concerned at all, given what we're seeing in the Red Sea and disruptions to trade that we are seeing, that there may be a little bit more inventory mismanagement heading for these retailers, or just inventory difficulty?
Well, I guess the good news is that retailers have been through this massive disruption before, and they've gotten better at inventory management. But I think right now, I guess again, the good news is that for the holiday season, things have slowed down, shipments are in, we start pushing into spring in the next 4 or 5 weeks. So if it had to come at any time, this is probably the least terrible time for it to come. But yes, there will be a couple of weeks of disruption. And as we know from the past, when we get out of whack with inventories, too much or too little, the margin cycle starts again of markdowns. But I think if the customer gets caught and there isn't a lot of inventory in early spring, then perhaps they look at the shelves and go, need to buy it now, going and willing to pay full price for the great innovative product out there.
Stacey, I can report firsthand from the Short Hills Mall in New Jersey, it was packed every day from Thanksgiving through Christmas. People fighting for parking spots, the whole 9 yards here. Give us a sense of how this holiday season broke down, bricks and mortar sales growth versus e-commerce. Are we still just riding that e-commerce wave?
Yes, so we've reverted back, and customers are absolutely going back to stores, and stores were positive this season, which is great news because, as we know, consumers come in and there's impulse purchasing and attachments. So that's great news. Digital was stronger than in-store still, about 2 to 3 times stronger, but at least you're seeing the customer come back to the stores. And again, we're seeing a return to purchasing in apparel. Again, not as many markdowns, more full price selling. Some eating out, some sporting goods was in high demand. I think you look at Lululemon, way outperforming. Nike had some conservative comments about forward guidance last week. But then again, we looked at the Adidas inventory in the U.S. Margins up, promotions way down. Things seemed okay. So I think it's kind of a season of pick your spots and pick your stocks wisely into 2024.
Okay, so you mentioned apparel, what some consumers are picking. What was not picked, Stacey? What didn't do well?
So I think if you go back to the department stores, and obviously there's some M&A action with Macy's, but Nordstrom is still under a lot of pressure in terms of their traffic. The customer's just not shopping that way anymore. And also, if you look at even the rack, TJX is absolutely on fire. Traffic is up, conversions are up, whereas the rack is still lagging. They haven't really figured out how to turn it around yet. But again, the full-line stores of Nordstrom are just trying everything to get the consumer back into that platform, and it doesn't seem to be working. So I certainly, as you look at this huge retail rally that we've seen in the last 3 weeks, you also see operating margins very peakish for a lot of these names. And even though a lot of the names like a Nordstrom or like a Williams-Sonoma have disappointed on sales, they're getting a pass by investors because their operating margins are intact because they're promoting less. I think as we look into next year, that's a tougher trade unless the revenue side turns around.
Stacey, I have a question on behalf of Kaylee. Talk to us about luxury here. How did luxury do this year?
Yeah, so coming off of COVID, right, when we had all those savings and luxury was booming, I mean, some of these names, they were up 30, 40%, their businesses, the true luxury, whether it was LVMH. But this year in the U.S., the spending slowed down months ago, but now you're also seeing Europe slow down, and it's a big piece of the puzzle. It's 30% for some of these larger brands, and you're starting to see the tourism now moderate. Remember, every American was running over to London and spending money because sterling was cheap and we got out of our houses. That's moderated. It's not happening anymore. So I think you're seeing in the U.S. and Europe, things slow down. I think LV was a bit slower. The best of those groups, like the slower, Kering was particularly quiet over holiday, and Burberry was very quiet over holiday. So those are kind of like the preferences of who did okay and on downward. So for luxury right now, probably not a lot of catalyst, particularly as the European piece of the puzzle that's been so strong starts to slow down.
Well, but what about buy now, pay later, Stacey? Something that usually could enable consumers that maybe couldn't afford to buy something expensive like a luxury watch or a luxury purse at full price right at that moment, but maybe can spread out those payments. Is that not enough to spur more of that activity? Because I feel like we talk so much about how consumers are using that pretty heavily.
And consumers have used it, and I think they've used it for lower ticket items, maybe not necessarily a $5,000 LVMH bag, I hope, if you can't afford it. Spreading the love out over time is not going to make it less painful. So I think, yes, in some categories in apparel, that's helped somewhat, where the payments are somewhat moderate. But also think about for the younger consumer, some of them are having their loan repayments started, and I think there's somewhat of a delay in the feeling that you talk about. You really start to feel that in early 2024 as post-Christmas, those credit card bills start rolling in at a higher interest rate, and then the consumer kind of takes a look and says, okay, I really need to get my spending under control now.
Hey, Stacey, one of the themes of retail over the last, 20, 30 years has been there's just too many stores here. And with the e-commerce, we saw a lot of retailers shrink their footprint. Where are we in that process today?
I think for some sectors, we're in better shape than others. Obviously, department stores, I still think we have a ways to go. I think we're probably still 20% over saturated in that space, and we need further closings. I think at this point, we saw so many store closings over the past 4 or 5 years. We're generally where we need to be with the exception of the department store space at this point.
All right, Stacey Woodlitz, thank you so much for joining us. Stacey Woodlitz is the president of SW Retail Advisors. Pretty solid, I guess it would be kind of a holiday selling season. You know, I'm going to walk down to Penn Station on my way home today if it's not raining too hard, and I'll go down Fifth Avenue or Madison Avenue, and the European tourists, they're back in total force.
Yeah.
Not so much for Asian Chinese visitors. I haven't seen that. And I know for a lot of the high-end retailers, they really depend on the China tourism. So
Absolutely. I mean, you mentioned luxury goods. China drives so much of that demand. And as we've learned in 2023, I think one of the great surprises was that that rebound on the part of the Chinese consumer did not really materialize in the way that many people thought that it would. So definitely interesting. But to your point, Paul, I've seen a lot of people out and about here in New York.
Sure,
people
absolutely.
are out shopping. I did all my shopping online this year. But
yeah, me too. I was out a few times just checking out the tree at Rockefeller Center and just packed. I mean, pre-pandemic packed people on Fifth Avenue, and you like to see that because it just shows that people are out and about, and hopefully the retailers are doing well. Coming up, we're going to check in with Ian Steely. He's JP Morgan Asset Management. He's the international CIO for fixed income. Fixed income had some positive results this year. How about that for fixed income? They got crushed in 2023. This is Bloomberg.
I notice in a couple of drugstores, even in my area, which is not the poorest area in Washington, D.C., it's a nice upscale sort of area. When I want to get razor blades, you have to go to the front of the place and ask somebody to unlock it. Why are you locking up razor blades and other things that I might want to buy?
Yes. So, you know, this is a national problem, and, you know, this isn't, you know, random theft. This is organized crime. And, you know, state legislation has put guidelines on, you know, how much you know, the theft that you can steal before you're convicted. So it's a $1,000 limit. But we have been partnering with other retailers and sharing our camera feed. I know some of our partners here from Walmart are here, but we are all part of an organization that's coming together that says if you've, you know, we can put our camera feed together and tell that that person has been in our store and their store, and the numbers are higher than 1,000. So we've been able to impact these theft rings most recently.
What are the things that are unlocking key the most? What are people trying to steal the most, other than razor blades?
You know, I will tell you, it started at razor blades because that's such a high ticket item, but, you know, it's a lot of cosmetics. But really what happens is that they take advantage of what I would call the elbow move, and they just come in and swipe a counter. And so it's just a matter of categories now.
This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close
A lot of this was priced into the U.S. session.
to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
All right, Katie Lyons, Paul Sweeney. We are live from the Bloomberg Radio Studio in New York City. We're simulcasting radio and TV, so that's pretty cool. I'm looking at Map Go on the Bloomberg terminal, and you look where ships usually sail when they're coming from anywhere around the world to get to Europe and traverse Europe. They kind of go through the Red Sea, then this thing called the Suez Canal. But now they have to detour, and if you look at the detour, it's no around-the-block detour. This is down around the Cape of Good Hope, around Africa. It's just extraordinary what has to happen here. And we had some more news come out today. Shipper Hapag Lloyd says the Red Sea route still too dangerous. So let's get to Brendan Murray. He covers all of this stuff for Bloomberg News. Brendan, this is no small thing to reroute some of these ships.
Yeah, it certainly isn't, Paul. I think we're waiting on Brendan to join us. But when we talk about the ships that are being rerouted, some of it is, container ships that carry goods. Some of it, though, is oil tankers as well, which is why we've seen this reflected to at least an extent in the oil market. For more on that now, we want to bring in Bloomberg's Alex Longley. So, Alex, we're seeing oil coming just off the highest level in about a month here. Is the primary concern for the oil markets the idea that this petroleum can't get to where it needs to go, or the idea that it's just not clear how much this conflict could escalate and what could happen in the Middle East? And it's that uncertainty that traders are more worried about.
Yeah, it's exactly that second one, and probably a third element as well is you have to keep in mind oil's had a pretty rubbish few weeks and months. We saw some pretty hefty action by OPEC Plus at their meeting in December, and the market shrugged at that, and we saw prices come off. And it's only really since these attacks in the Red Sea have escalated, and in particular, actually not since the oil tankers have started diverting, but since the big container lines, Maersk and Hapag-Lloyd, as you mentioned before, it's only since they began rerouting away that the severity of this situation became clearer, and that's when the oil market began taking note. I think one thing to keep in mind is although prices have rallied, we haven't really rallied that far in the scheme of where we've traded this year. We've come off sort of the low end of the range it's been in. But compared to the risk that you see from disruption to the Red Sea, you could make an argument that actually oil's not done a lot at all.
Yeah, that's kind of where I wanted to go, Alex. I mean, I think like a lot of people, I'm learning a lot about the Red Sea and what it means for global trade. Roughly 12% of global trade does go through the Red Sea. How is it in the world of global oil? How critical is it?
It's absolutely vital, and perhaps one of the more interesting elements is the way it's changed in recent years, particularly since Russia's invasion of Ukraine. Before that, much of Russia's oil exports went to Europe. It sailed 1 or 2 days to countries like Poland and other neighbouring European countries. Now what happens is a lot of that oil travels through the Suez Canal, down the Red Sea, and across to buyers in India and China. So it's actually become a vital waterway, not just for the West, but also for countries like Russia that rely on it for its exports. The flip side of that, Europe has replaced a lot of that Russian oil with barrels from the Middle East. Again, the primary way of getting barrels from the Middle East to Europe is through the Red Sea and the Suez Canal. So that's just a snapshot of the way in which it really is a vital waterway. And keep in mind as well, I mean, as you alluded to at the start, ships can go the long way round. It's not the be-all and end-all, but the problem is how much that draws out the trade. It makes shipping more expensive, it adds to the cost of barrels, and it takes them longer to get there.
Yeah, Alex, it's a really good point. And on that point, we want to bring in Brendan Murray, our trade czar, who is with us now. So, Brendan, as we talk about how vital the Suez Canal and the Red Sea is, I think it's 12% of global trade goes through this waterway. And the idea that now it's not going through there, it's going around the coast of Africa. For these big container ship companies, when they've made the decision, all right, we're going around, they're not likely to just turn around and go back to the Red Sea, right? Once you commit to the voyage, do you take the voyage all the way? And I just wonder what that means for when we might see activity in the Red Sea actually normalize.
Yeah, exactly. So what we see right now is about 300 container ships, 300 plus, currently having diverted or made the decision to do so soon. So that is that's a fair number of ships, equating to about 4 million 20-foot containers. So that's you can imagine 4 million containers is a little less than half of what the Port of Los Angeles handles in an entire year. So that's a fair number December. But like Alex suggested, ships are pretty flexible in their schedules. They can turn around. They can start rerouting ships again to go through the Suez Canal if the situation there becomes more safe. So the system has got some flexibility built into it, and it can shift back to the old way, the shorter way of shipping things fairly quickly. But we've yet to see the big wholesale turnaround in the industry that it would take to let people know that this situation is stabilized or getting less severe.
Hey, Brendan, the U.S. Navy is in the region. What kind of impact are they having on security there?
So it seems like the confidence from the shipping companies is slowly starting to improve. A week ago, they put out the call for urgent help from the navies in the region, that their ships were under attack and they needed some protection. That seems to have improved a little bit this week. We heard Maersk say that they're evaluating plans to sail through the Red Sea and the Suez Canal as soon as it's feasible. Now whether that's feasible tomorrow or 3 weeks from now, we don't know, but they're ready to make that adjustment as soon as they deem it safe to do so. So it seems that there's a slow belief that the situation could improve. The ships will get the protection that they need, but it's not clear at this stage. It's heading in that direction, though.
Well, and of course, when we think about the operations of the U.S. Navy or the operations of anyone in this maritime task force the U.S. has assembled, it's really defensive. They're doing things like shooting out down drones, coming to the aid of ships that might need it. To this point, it hasn't been offensive, and yet Bloomberg has been reporting over the last several weeks that the U.S. is considering whether offense may actually be needed here, potentially direct strikes against the Houthis. And Alex, one of the concerns with that is on the part of Saudi Arabia, who really prefers something more measured because they've had their energy infrastructure targeted in Houthi attacks before. And how should we be thinking about kind of the oil infrastructure side of this equation as we think about potential escalation?
Well, I think in the Saudi case as well, that there are very interesting parallels to an extent to the situation we see now. And it's actually to your first question of why haven't we perhaps seen a bigger impact in oil prices? If you think back to 2019, when we had the attacks on Saudi oil infrastructure, on Abqaiq, and somewhere between 5 and 7% of global oil production was essentially blown up overnight. Now, on the one hand, yes, that was fixed within a couple of weeks and the barrels came back very quickly. But I think what that shows you more generally is that the oil market tends not to react unless you see a really meaningful long-term supply disruption. And what we've seen so far is disruptive for sure, but it isn't disruptive in the sense of losing barrels out of the market. It might mean the odd ship takes the long way round. It might mean some cargoes are slightly delayed, but this isn't a meaningful hit to the global oil market supply and demand balance. And I think that's what people are looking for here. Keep in mind as well, OPEC plus relationships here. I mean, shortly before Christmas, we had Angola announcing that it's leaving OPEC plus, which is just a reminder that it's not just Middle Eastern politics that is at play here, that there is a whole maelstrom of global oil politics, and throw on top of that as well booming US oil production growth that have kind of helped to balance this oil market this year, and again to keep a lid on prices at a time of very elevated tensions.
Hey, Brendan, I want to ask you to put your trade czar hat on here. I mean, in terms of the global supply chain, which I think we all probably got a lot smarter over the last several years than we were before the pandemic. As it relates to Europe, how do some of the issues going on in the Middle East, in Europe, Ukraine, how is that impacting kind of the overall supply chain in and around Europe?
Well, some of it's being offset by pretty weak demand in Europe at the moment, even weaker than the U.S. economy is. So the heavy demand for consumer goods and auto parts and the kinds of things that are flowing steadily when the economy is going strongly, then that we're not seeing that at the moment. So this decline and this disruption that we're seeing, these delays will be sort of offset to some extent by the weakness of the European economy. But if you're an automaker and you have a shipment of parts coming in from Asia, and those are delayed for 3 weeks, that can throw a whole production line off. So it's going to depend company by company and product and part by each individual container full of goods that come in. There will be some initial disruptions, but whether this turns into some big shock like we saw during the pandemic, we're a long way from that. But I think we'll see the ripple effects of it play out here in the next few weeks.
Well, and obviously we've all been paying very close attention to what's happening in the Suez Canal and the Red Sea because there has been so much activity and conversation and media coverage of it. But I've noticed as well that what we seem to be leaving out is what's happening in the Panama Canal too, Brendan. The idea that there's a lot of these really vital choke points potentially of trade that are in jeopardy in the Panama Canal. It's because of drought and low water levels. How concerned should we be about that?
Yeah, a lot of the ships that were going to go through the Panama Canal rerouted through the Suez Canal, only to find the attacks going on from the Houthis. So yeah, there's quite a few choke points at the moment. The net effect is they're just going to put upward pressure on freight rates, which have come down significantly this year, 75% or so. So we're not looking at a hugely inflationary kind of situation, but if you're a company, if you're Walmart or you're IKEA, and you thought your freight rates were going to be really low through 2024, you're probably redoing those estimates. So it's as you said, these are kind of rolling shocks, not the big jolts that we saw during the pandemic, but kind of rolling, sort of grinding shocks that will affect the price of things on the margins in the months ahead.
Hey, Alex, what are traders saying about I don't know, next several weeks, several months in terms of where they expect oil to go? Because I'm looking at it. Yes, it's bounced off that low recently, but still well below Brent crude, $95, $96 that we had back in late September.
Yeah, for sure. I think supply is the big narrative in the coming months. For all the talk of a recession and sort of slowing global growth, whether interest rate cuts are coming, I think the last sort of 12 to 18 months have shown there's always been talk about the demand side of the equation, and generally speaking, demand has been fine. If prices are going to move higher, it's going to take an underperformance from probably US shale production, which again, people have kind of called the death of many times, and it continues to reinvent itself. We see consolidation in the US at the moment that I think people expect to see more oil come out particularly the Permian. Other non-OPEC producers, Brazil, Guyana, even Norway is producing a few more barrels. And there's lots of smaller additional supplies that prove a headache for OPEC Plus. And then you have the wider question on the supply side of how long does OPEC Plus keep cutting if prices don't move higher. And I think that come the first and second quarter of next year, we've already had kind of prolongation into the early months of next year. But I think as we move through and beyond the first quarter, focus is really going to come back onto the supply side of the equation and whether that non-OPEC supply growth is outpacing or is what's sort of exceeding what's required from demand, as the demand side of the oil balance has pretty much been fine for since 2020, essentially.
Yep. Well, I can tell you over here from the US of A, we're fracking like crazy over here and continuing to ramp up production. Smart discussion, and we appreciate our guests, Brendan Murray, Alex Longley, Bloomberg News. They're over in London giving us the latest on what's happening in the Red Sea, impact on global trade, including global energy prices. And I think one of the things that may long live past the pandemic is this whole supply chain and moving away from just-in-time inventory, which is something we all learned over the last 20, 30, 40 years. Now it's a little bit more just-in-case inventory, have a little bit more slack in there, onshoring, friendshoring. Those feel like things that are last.
Yeah, prepare for the unexpected. And maybe that's why, because supply chains are more resilient, you won't see as much disruption this time around as a few years ago.
All right, S&P 500 unchanged on the day. How about that? We'll have more coming up. This is Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Welcome back to Bloomberg Markets simulcast today on both Bloomberg Television and Radio. I'm Kaylee Lyons alongside Paul Sweeney, and what I believe is the third to last trading day of the year, Paul, right? Yeah. We got 3 days to go. The end of the year is very, very rapidly approaching, and what a year it has been for the bond market. If you look at Treasuries specifically, right now we're trading at 382. We reached as high as 5% at one point on the 10-year Treasury, as low as 3.3%. But for all of that, after starting the year at 387, we're just about 5 basis points on the year changed. Pretty remarkable. So what is going to come in 2024? Joining us now, I'm pleased to say, is Ian Steely. He's JP Morgan Asset Management International Fixed Income CIO. So Ian, where should we expect yields to go in 2024? And is it going to be as volatile as 2023 was?
Hey, I think the reality is it probably is likely to continue to be volatile. We've obviously had this huge move just over the last couple of months or so, as you said, all the way down from 5% to where we are today. There's a lot of cuts priced in by the Federal Reserve and other central banks around the world going into next year. And it's going to be a case, I think, of looking at the data, keeping an eye, particularly on the jobs market, looking at where inflation goes as to whether we can deliver those cuts. But the reality is, I think the Fed's let the cat out of the bag at the last meeting. They do want to ease policy, so that should be good for the bond market.
Ian, I'm looking at the Bloomberg Index browser. I can do that by typing INGO in the terminal. And I see pan-European high-yield debt had a total return of about 12.5% this year. That is very strong performance after what was a brutal 2022. I would think with all the recession talk that maybe high yield would not have been the place to see this kind of performance. What do you make of the European high yield market this year?
I think what the bond market typically does is it typically looks forward. So there were big concerns around economic activity in the Eurozone, particularly on light of the conflict in the Ukraine and what was happening to gas and energy prices. But the reality, it was forward-looking. And as we came into this year and we didn't have some of those very negative GDP prints that were at points expected late last year, the market took comfort from that. And although we've had a fairly slow growth environment, and we're sort of bumbling around at zero at the moment, that's absolutely fine for a lot of corporate bonds and corporate companies. And that clients were looking and investors were looking at the spreads they were getting, at the all-in yields they were getting, and thinking they look pretty attractive. They're yields that they've not seen for a number of years in the European bond market, and we saw a lot of people thinking that was a good time to get invested.
Well, Ian, when we think about Europe, the ECB is doing something that the Federal Reserve, frankly, isn't really trying to that much, which is push back on the market expectation that the easing will be kind of aggressive next year. The Fed doesn't seem to be fighting that narrative that hard. As you said, they basically have admitted themselves they're going to be easing. But Christine Lagarde was trying to push back in a more meaningful way. And I just wonder if you think she, too, is going to be throwing in the towel in the not-so-distant future.
I think she would be, because I think actually when you think back to that week, it was quite strange that it was the Fed pushing back, where actually growth's been reasonably strong and the economy is holding up quite well. Whereas actually when we look at Europe, you've got, I say, fairly anemic growth and actually inflation, which is slowing at an even faster pace than the US. So I wouldn't be surprised at all if during the first quarter we see the ECB pivot and do a Federal Reserve in a way and look towards more easing next year. And the market's already pricing that, so I don't think it would be a surprise to anyone.
Ian, do I want to be short-term or long-term here? How much risk do I want to go out there in terms of the curve in 2024?
I think you do want to be thinking about what the upside versus the downside is in yields. You've now had central banks which have pretty much told us they're done, barring a big upward surprise in the data, and that they want to ease policy. They believe they're restricted. They believe the next move is going to be lower yields or lower rates, and that should be good for the bond market. Now, granted, we have moved a long way in a very short space of time, and the way I would think about it is you want to own bonds, but you also want to have capacity to buy bonds. So buying backups in yields makes a lot of sense to us at the moment. Owning high quality fixed income. If you can get corporate bonds with a yield north of 5% and inflation heading down towards 2%, that's a pretty attractive real yield to lock in and make sure that you get invested in that now.
Well, Ian, when we think about inflation, though, and yes, it does seem like central banks think pretty much their job is done, that they're going to be able to start cutting rates in the not so distant future. But I think back to conversations we've had just on this program. We were just talking about what's happening in the Red Sea, potential risks to supply chains, costs moving higher. We also were speaking to a retail specialist earlier in the last hour, talking about how consumer demand is still pretty resilient. People are out there spending. And I just wonder if there is still more inflationary risk out there than maybe this market anticipates. How much upside risk is there really in that regard?
So if you look at the very near-term inflation prints, and if you look at the 3-month or the 6-month moving average, definitely heading down in the right direction. We saw that with the PCE numbers, the Fed's favoured measure, just before the holiday period. And what we were looking at the moment is goods. Goods is almost in deflationary environment at the moment. Services is coming down. It feels like we're heading in the right direction. I do completely agree with you that the US consumer continues to look robust. But you've got a central bank that's saying we've taken rates into restrictive territory. And with inflation coming down towards their target, they're going to be happy to ease into that. It might be a case of normalizing, not actually taking it to an easy level, but that should still be pretty supportive for bonds. And then if you do get more of the hard landing and more of the slowdown that some people are expecting, then that's going to be a really good environment for bonds. And if you go back through previous cutting cycles, the market does typically underestimate the amount of cuts that the central banks need to do. So I think it's worth also bearing that in mind.
Ian, talk to us about credit quality here. In the States, credit quality has held up really well. Yes, there was a lot of stimulus money, and that's certainly helping, but quite well here. How about in Europe and the UK? How's the credit quality situation there, and how are you kind of positioned?
So if you look at the overall, maybe go back to the European high yield market, it's actually a very high quality market. It's majority of it's in the double B space, so the upper end of the high yield space. And actually, when you think about it from a corporate standpoint, corporates are fine with growth that is hovering around zero, slightly positive when you've got inflation positive as well. What corporates don't like is deep, sharp declines in activity, deep, sharp declines in GDP. And that's not happening at the moment. We're not seeing that at the moment. And if you do get an environment where we get easier policy, rates are coming down, that should continue to be supportive for the corporate market. So actually, when we look at the fundamentals from a corporate standpoint, very comfortable with them at the moment. We think high quality investment grade, high quality parts of the high yield market in Europe are particularly attractive, particularly where the spreads are relative to the US market. You're getting much wider spreads in Europe, so a lot more opportunity over here.
Well, and Ian, I wonder if you are expecting there's just going to be more out there to consider buying. If borrowing costs become more reasonable, are we going to see suddenly just a huge amount of issuance coming?
We're always going to get issuance, but I always think that issuance comes when there is demand. And if you're getting the demand for the bonds, the companies are going to issue. Now, we did see a lot of issuance occurring from corporates during the pandemic, during the period of very low interest rates. They did exactly the right thing. They issued at low yields for long periods of time, long duration. That made a lot of sense. So they will use a window of opportunity to issue, but they don't actually particularly need to issue a lot over the next few months or so. So again, that should be supportive for the bonds market.
Hey, Ian, just finally, in terms of credit, what's the sector that you guys like the best right here?
I think from a valuation standpoint, you just need to look at the banks. Okay. And if I think particularly in the Eurozone, if you look at the contingent convertibles, the AT1 market, you're getting on average a spread of around 500 basis points, maybe slightly lower than that for the real high quality banks. But I think the banks are very robust in health. They've got a lot of core equity tier 1 rate sitting on them, and they've got that spread. So you're getting what I would say is a higher quality asset than high yield for a significantly wider spread. So really, I think that's going to be a good spot to be as we move into next year.
All right, thanks. You heard it here. Ian Steely, JP Morgan Asset Management, International Fixed Income CIO. I think he's over in the Bloomberg office at Queen Victoria Street, which are awesome.
I've never been there.
Oh, it's very cool.
I know.
Just an
I need
awesome
to figure
building,
out how to get
awesome location, right in the center of the city of London, kind of their Wall Street area, right near the Bank of England. So you can't get any closer, to kind of the financial center of the UK.
But how's the pantry?
Pantry's outstanding.
Okay.
Great view
That's
of
my-
St.
that's
Paul's
my
Cathedral,
metric.
too. Yes, yeah, and great pantry, great views of St. Paul's Cathedral. So they did a great job with that. So, all right, looking at these markets, absolutely unchanged on the S&P. Dow up about 1/10 of 1%. NASDAQ off about 1/10 of 1%. So a whole lot of nothing going on out there in terms of the indexes. And you can't say indices. Matt Miller will be all over you. It's indexes.
Oh, yes, that's in the style guide.
Yes, it's in the style.
Indexes.
Yep.
And interesting to see in the bond market, Paul, we're down 7.5 basis points on the 10-year right now, 382.
Yep, keep moving there.
Yeah.
Coming up, Joe Cavatoni of the World Gold Council on his outlook for gold going into next year. That's coming up. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. The island emerging as a flashpoint between the U.S. and China. Taiwan's presidential election is drawing global attention.
Taiwan is an elephant in the room.
After the Biden-Xi Jinping summit,
We had some pretty tough talk.
bracing for potential war scenario.
As voters head to the polls in January, Bloomberg takes a close look at the candidates, the issues at stake, and what it means for the world. In case you missed it, watch Taiwan Decides, a special report tonight at 9:30 Eastern. Bloomberg, context changes everything.
All right, Bloomberg Markets, we are back. Kaylee Lyons, Paul Sweeney. We are simulcasting Bloomberg Radio and TV from the Bloomberg Radio Studio, my home, away from home here at Bloomberg Global HQ here in New York City. I'm looking at Bitcoin. You know, just because Matt Miller has got me thinking Bitcoin, because he's one of the original Bitcoin people. It's up over 150% this year, which is just extraordinary in any year, particularly in a year when, Kaylee, two of the exchanges basically went belly up. And there's so much concern about the secrecy and security of crypto. But boy, just a rip-roaring year for Bitcoin, showing you the just amazing asset class there. Yuchi Yang joins us. She covers all things crypto for Bloomberg News. She joins us live here in our studio. Yuchi, looking back on 2023, I didn't see it coming, but I mean, did the crypto space, how do we look at it now in a world where we've had FTX and other issues, Binance? How do we look at crypto and Bitcoin?
So the year of 2023 is the year of recovery for a lot of people in the crypto industry. There's the sense that now that Sam Bankman-Fried was convicted, everyone could finally move on to the next thing. Some of the negative overhang has been removed. There's still a lot of regulatory uncertainty in the U.S. with ongoing court cases. For example, the SEC's lawsuit against Coinbase is still going on, but the prices are coming back up, and a lot of it was driven by this optimism that the U.S. will finally approve a Bitcoin ETF that invests directly into Bitcoin as early as January.
Yeah, a spot ETF that's never been approved before. Obviously, there's a futures ETF, but the SEC, Yuchi, has said historically that there's a difference between spot and futures, and spot's more vulnerable to manipulation. At least that's what you hear from the SEC chair, Gary Gensler. But you mentioned how there's court cases. It really seems like it was the Grayscale case that made the difference here. They, of course, were trying to convert their Grayscale investment trust into a spot ETF. The SEC said no, Grayscale sued, and the judge said the SEC was wrong. That happened a while ago, and maybe that's why we've seen the rally over the last several months. But how does that move forward? Are we likely to see Grayscale resolved before a spot ETF is approved? Is this happening all at once? What do you hear when you talk to people who watch this market?
So yesterday there was this interesting piece of news coming from Grayscale. They've decided that Barry Silbert will be stepping down from the board of Grayscale Investments. And for a lot of people in the industry, some analysts told us they're seeing this as a positive step building towards a potential Bitcoin ETF conversion. Grayscale said that they're also doing this step in the context of getting ready for the next chapter of the company. So we'll see whether they will be the first or someone else will be the first. That's still uncertain yet, but that does contribute to some of the price optimism in the industry.
So how big, frame this out for us, how big is having a spot ETF? It seems like it's transformational, just because I look at all the funds flows that are going to ETFs in general, and then you layer on top of that the excitement around crypto in general. It seems like put those two together, you really got a transformational event potentially. Is that how the industry's thinking about it?
I think there are two aspects. So on one hand, it is going to be big, but then they're also concerned that because Bitcoin price has rallied so much this year, maybe some investors will actually take profit once the Bitcoin ETF approval decision comes out. And so that could be a potential risk, at least in the short term. But then when we talk to people in the industry, especially people who are running crypto hedge funds, overall, they're very bullish. They think that regardless of the ETF news, it will be a great year just because of the combination of macro factors with Fed pivot, as well as industry-specific factors, such as the halving of Bitcoin, which will, of course, reduce the supply of Bitcoin. So they think that they're aggressively positioned for a good year in 2024.
Well, it's so interesting because when we talk about what probably would be seen as a regulatory victory for the industry, the approval of a spot Bitcoin ETF, there's still a huge regulatory overhang around all the tokens that aren't Bitcoin, right? The SEC has said, sure, Bitcoin is not a security, but they think most crypto tokens are. And that's not necessarily something that's going to change. Wouldn't that be kind of a headwind for everything that isn't Bitcoin?
Yeah, I think it will be a headwind, especially in the U.S. A lot of the crypto companies now are trying to, I guess, diversify their offerings by going overseas, Coinbase being one of them. And then at the same time, I think that for the crypto market, even the U.S. Presidential election in 2024 could be a potential risk factor because obviously the regulatory direction of the U.S. will be very important for the entire crypto industry.
Yeah, and then there's at least one candidate out there, Vivek Ramaswamy, who is really into crypto. I think he's the only one that's actually put forward a crypto policy platform. So definitely an interesting thing to watch as we head into this new year, which of course is an election year. Bloomberg's Yuqi Yang, thank you so much for joining us. Often we hear Bitcoin talked about as digital gold, and we want to talk about the difference between digital gold and real physical gold, like gold bar gold. Joining us now is Joe Capitani. He is World Gold Council's chief market strategist. So, Joe, does gold have any real reason to fear Bitcoin?
No, I don't think we do. I don't think there's any reason to consider Bitcoin a threat. Quite the contrary. What I'd say is that if you're going to own Bitcoin in your risk portfolio, which is a risk asset, I'd say it bodes well for the case to continue to increase your allocation for gold, which will offset that risk with an asset that is a real asset that's predicted and easy to understand, easy to analyze, and you can see the consumer side of it, you can see the investment side of it, the demand side of it, and also understand the supply side of it. I think it's very interesting when you look at Bitcoin and the momentum that it's had over the course of the year, a lot of which has been driven by potential for clarity around regulation, potential for new mechanisms or vehicles to access it. Outside of that, the use cases are still very unclear. There's still opportunity, but they're still very unclear, and adoption is still very early stages. So we look at it as a risk asset. We can look at gold and show you the demand side where central banks, investors, consumers in the form of jewelry, and also in technological applications, and give you a pretty clear picture on why that is an asset that'll help offset risk in a portfolio.
Joe, can you tell me who buys gold? Who's buying gold these days?
Lots of people are buying gold, but the big standouts that we've had over the last 2 years, considering we're nearly done in 2023, have been central banks, and we've had pockets of retail buying of bars and coins. But central banks have actually set a record in 2022 and have been through third quarter of 23 on record to set another tonnage record in terms of the consumption of gold. Now, they have been buying. These have been mainly emerging market and developing economy central banks, but there have also been developed markets, central banks that have been buying. China, Poland, Turkey, others, the emerging market banks, but Singapore, Ireland, the developed stage. They've been buying for the reasons of diversification, risk against inflation in their own portfolios, dollar risk in their portfolio, asset benefits when it comes to liquidity and so forth. And they've been buying it simply as a diversifier to their reserve portfolios. Again, a record in 2022 and on track to be a record in 23. And I think what's important is that what we've seen more recently have been geopolitical risks likely weighing in on their decision to continue to diversify to gold, plus the noise and concerns around whether the dollar's here to stay or a de-dollarization market will develop over time. We think that's less of a factor. What really is a big factor is diversification benefits in the central bank portfolios, and then ultimately having the ability to maybe manage a bit against risks that come along the lines of geopolitical, whether it's a conflict in a particular region or a need to manage your own political situation on shore like we saw in Turkey over the course of this past year, or maybe even prevent some risks that come along with a knock-on effect of sanctions. I also mentioned retail being a source of demand. In the U.S., we had pockets of quarters where we saw large demand increases. They weren't major blows in terms of the U.S. retail market, but ultimately you saw first and third quarters where risk events or political events, geopolitical events, I should say, pop up, and they ultimately led to movement into the gold space, not in ETFs, but in bars and coins. So those have been the two big surprises for us this year.
Yeah, super interesting. I know you were speaking primarily about, emerging market central banks as being big buyers here. But when we think about the developed market central banks, the big ones like the Fed and the ECB, how much is the case for gold predicated on what kind of landing they're able to pull off, if it's soft or if it's not?
That's been it. So what I've talked about in terms of those sources of demand, global demand, emerging market central banks, pockets of retail successes, it's all been offset, and the headwinds we've been facing is all eyes on the Fed. We're waiting and expecting to see that decision, those steps forward, the rate environment going forward being the most likely factor in the market that will lift what's been pretty much a cap on the gold price And we're starting to see it as we speak over the last couple of weeks of the year here, when people are building in, expecting and pricing in rate cuts into 2024. Now, when they happen, will they happen? That's the risk we face with gold right now. If we get more of the same, which is, we were calling this a little bit earlier this year, that rates were going to be cutting, we were expecting it to happen, and actually what we got was a long, tiring year of waiting to see, and further rises in rates. But those were the moments that kept gold capped. And I think if we see the rate cuts coming, if we can see that on the horizon, that's going to lift the gold price, and we're going to actually see a good environment, or even a very, very interesting environment for the gold market. If it's a soft landing, that'll be one where opportunity cost and actually those momentum and risk moments will continue to support the price for gold. But if it's a hard landing and we actually have a lot more risk into the system, then you're going to actually see the flight to gold be much more substantial.
So I'm actually surprised, pleasantly so, I guess, that gold has been rallying in what is increasingly forecast to be a soft landing. I thought people would have traded out of some of the less risky assets and put on a risk-on move into stocks and bonds, but that hasn't been the case recently.
Well, I think they are adding to risk, but I also think that the environment that we're seeing is that the gold market will benefit from a few things. I think it's definitely going to see those rate cuts move people into the allocation of holding a stable value in terms of gold. I think it's also a dollar weakening that's actually kept people moving away from the dollar into gold. And I think ultimately what you're going to find as we move into 24, it's going to be clearer for us as to whether or not we move into recession, or if we actually come into a much more comfortable soft landing, I guess is the way to put it. And ultimately, in that kind of an environment, we'll probably have maybe a bit of a stall in the gold price. But I think if we start to see that recession surface, that's an environment where gold does well. That safe haven, that savings mentality, that flock to a store of value, both on the investment and on the retail side, will actually surface. And let's not forget, gold's a global asset. So we talk a lot about the U.S. rate environment. We talk a lot about the U.S. dollar. Yeah. But you've also got consumers in China. Earlier in your program, you were talking about where you're seeing them, where you're not. I actually saw quite a few Chinese consumers in Las Vegas over the last week when I was there. But ultimately, what I think you need to keep an eye on is where does that head in India and China? Large markets, large consumer demand for gold. You know, they've been tapering somewhat in terms of jewelry demand, but what's been surfacing in both of those markets, interestingly, is gold as investment. So bars and coins versus jewelry. And ETFs, which is a little bit of a bright spot in the ETF landscape in 2023, Asian markets, China and India. Large amounts of products on offer, but small relative to the big markets, but still growing. So you're starting to see that shift. Are we seeing that in Asia more broadly? We'll keep an eye on it. Right. It's a global asset and global market.
All right, Joe, we got to leave it there, but thank you so much for joining us. That's Joe Cavatoni, World Gold Council's chief market strategist. And he was talking there, Paul, about jewelry. As we know, often that can include watches. I want to talk about a watch of a different kind, because the headline just crossed the terminal. The Apple Watch sales ban that was put into place by the U.S. International Trade Commission has been put on hold by an appeals court. This is, of course, a patent dispute. There was a review period that ended on Christmas Day. The U.S. Trade Representative Catherine Tai had a chance to veto the decision from the Trade Commission that would have put the ban into place. And now an appeals court essentially has said, all right, hold on here. So this is a win for Apple. Interestingly, though, you're not really seeing it reflected in Apple shares. They're down by about 0.5% right now.
And they're up about 48% year to date. So it hasn't been that big of a material issue for the company or the stock, but still good news. It's rare that you see kind of a legal issue for Apple as it relates to patents. All right, we're going to recap the year that was in the banking industry. That's coming up. This is Bloomberg.
Josh, that's me, Max. What's up? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're going to ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. like, please, like, really actually tune in. I desperately need an audience.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome back to Bloomberg Markets simulcast today on both Bloomberg Television and radio. I'm Kayleigh Lyons alongside Paul Sweeney in our Bloomberg radio studio here in New York, where despite the fact that it's a holiday week, there's still plenty of news out there and some breaking news just across the terminal after the Apple Watch sales ban was put on hold by an appeals court. It's now a red headline, and of course this is a patent dispute, Paul, with another company, Masimo, over the blood oxygen technology in these Apple Watches. And Masimo, interestingly, is falling 5% in today's session as that ban has been paused, at least for now, by the court. So this is a legal fight that clearly is going to be playing out in the technology sector. We want to focus, though, not just on technology today, but about banks. I feel like a lot of people have been saying to buy banks today.
Yes.
Or buy bank credit.
Credit, yep.
And so that's a conversation we want to have next, and a conversation actually that already took place with Brian Moynihan, the CEO of Bank of America, earlier on this month. We want to play a little bit of that conversation with David Weston now.
We have the #1 research team in the business, and Candace and the team do a great job. They just shifted yesterday, literally, and they moved to more rate cuts in 24. But the real key was, what do they see in the economy? And they basically have moved from a 0.5% growth rate annualized for the first 3 quarters of next year up above 1%. So they've softened their soft landing, let's just say that. And by doing that, they've said when the Fed is seeing inflation slow as fast as it is, they basically think we get down to the low 2s in inflation by the year, and next year, 24, and it carries into 25. The Fed needs to bring the rate structure down. They're saying basically 200 basis points of rate cuts, 100 next year and 125, which still leaves you at 3.25, 3.5. Now, the last time we were fundamentally at that rate structure was it was 18 years ago by the time we get there. So we've had a long stretch of very low rates, except for what happened very recently. And so that fueled a lot of activity. And now the rate structure can be fundamentally higher. It's more structurally sound. And the Fed it's not really pivoted to say we got to normalize this because we're seeing the economy and the inflation come in. Not done yet, but all indications are doing there. And everything we can see that consumer spending is consistent with a 2% inflation economy. That level of spending growth in our customers was where it was in 17, 18, 19, when the Fed raised rates to bring the economy back in sync.
Are you concerned at all that the markets may be overreacting to what they heard from Chair Powell?
I think he's got this challenge that, he was, the Fed in their own mission was late to cutting off inflation. Now he's been careful not to be late to stop cutting off inflation. And the market's going to ebb and flow. But I think people have to be a little careful. This is trading talk. This is, the 10-year moving around between, 390 and 450 and 470. It's not the real economy. The real economy is still heavily impacted by the overall rate level. It's very restrictive, and it's still coming through the system. Against that, we still have a lot of stimulus coming through the system. Yep. The infrastructure bill, the CHIPS Act, the IRA, those are all still coming through the system. So that's a tug of war he's up against. But overall, we believe he's engineered a soft landing through the interest rate environment.
All right, that was Bank of America Chair and CEO Brian Moynihan. He sat down with our own David Weston last week to talk about the state of the economy and the outlook from our good friends at Bank of America. Just looking at the stock of Bank of America, only up about 2% year to date, so pretty significantly underperforming the market. But when we talk global banking, global investment banking, we talk to Sri Natarajan, Bloomberg News. That's his beat. He joins us here in our Bloomberg radio studio. So you get a gold star for that, Sri, coming in on this week in particular. Sri, as we look out to 2024, I'm glad I'm not sitting down across the street, the desk from my bosses back on Wall Street trying to negotiate a bonus this year, because it wasn't a great year on Wall Street for deal flow and trading and all that kind of stuff. What's the expectation for 2024?
It wasn't a great year, but remember that the outlook, when we're thinking about 2024, when we're thinking about this idea of rate cuts flowing through the system, about deal activity picking up, about capital markets picking up, in some ways, if you are a high-ranked staffer at any one of these big banks, these banks need to make sure that at least their top performers are taken care of, because the next few months, the next several months, could be a bonanza for the big banks. And in fact, heading into the end of the year, we were all talking about how once the rate cut cycle takes hold, bank stocks would be a very attractive place to be. Of course, in the last couple of months, we've seen a big rally. We've seen bank stocks climb about 30, 35%. So some of that has played out. But considering that where activity levels were for much of this year, we're looking at a 2024 that promises to be much better for most of the banks.
Well, what about JP Morgan? There's a great story out on the Bloomberg terminal today, and the headline, I think, says it all. It was a tough year for almost every bank not named JP Morgan. And Sri, obviously, this was primarily because they were able to buy First Republic, one of those regional lenders that failed, that made them bigger, it made them more profitable. Ultimately, is everybody else going to be able to play catch-up to JP Morgan?
It's not a wrong headline, right? You have JP Morgan that's up 25% this year. The second biggest bank in the country, Bank of America, is up 2%. The big gulf there, and of course everyone else in the middle, but the big gulf there is also what happened with Bank of America is they missed out on such excess profits because of how their portfolio was positioned and how it got impacted by the rate moves. JP Morgan, however, was not handicapped by that, was able to capitalize on what felt like a looming crisis in March.
A mini crisis, perhaps.
Became a mini crisis, then got further diminished into this little California banking crisis. But JP Morgan was again able to benefit from everything that happened then, what happened with First Republic, being able to scoop up First Republic. It comes out much stronger than ever before. You have JP Morgan that's on track, based on our estimates, to post $50 billion in adjusted profits for the year.
Nice.
Just to give you a sense of what that means, Goldman Sachs' entire revenue for 2023 is expected to be about $46 billion. That's how good a year it's been for JP Morgan.
That would be the biggest annual profit in the history of American banking, Paul, according to our story.
And so when you hear Jamie Dimon carp about regulations, you got to put it in context. All right, Sri, that's kind of where I wanted to go. Goldman Sachs, I know you do a lot of work with those folks there covering that company. I competed against them for more than 20 years. Some days I won, some days I lost. Probably lost a little bit more than I won against those folks. They're good. But they lost their way a little bit, one could argue, over the past few years. An example would be the foray into consumer banking. What do you expect out of Goldman Sachs strategically over the coming year?
I would say a lot of 2023 was, the year of mea culpa for them, right? They acknowledged their mistakes. They accepted defeat on some of their newer forays, whittled that down, got out of some of these things, all this exciting Apple Card and GM credit card and all those consumer banking expansions. They're like, that's a thing in the past. We want to get out of that. We're not out of that yet, but they're trying to get out of that. Now they're saying, focus on the forward. There are two key pillars. We've had an asset management and wealth management division that's been there for about 20, 30 years. That they want to position well for success. And you have the investment bank that, undoubtedly Goldman has been among the very best in that for several decades in a row now. So if you see the broader economy pick up, and more importantly, if you see deal activity, capital markets activity pick up, Goldman will be in a good position to benefit from all of that. The big question mark, of course, that hangs over Goldman, and not just Goldman, almost every other big bank, is what happens with those capital rules that have been proposed by the Fed, because that will ultimately have a big impact on how investors see these bank stocks. Would they still see them as desirable if a lot of those rules go through as proposed? Or should we put a lot of stock, in the words of a lot of these senior banking executives who, after having railed on these rules for a while, also are cautiously optimistic that a lot of this will get torn up, redone, watered down in a way that they will not be encumbered too much.
Yeah, I mean, Sri, I'm usually in Washington, and the local TV stations there are running commercials from bank industry groups, essentially telling your lawmaker, push back on these higher capital requirements. And certainly, at least on one side of the aisle, you see a lot of pushback from the Republicans on the idea that these are going to be higher. The banks argue it's going to be detrimental. They aren't going to be able to loan as much. But to Paul's point, they're doing pretty well. They really can't take it if indeed what Michael Barr has proposed goes through.
Their point is, yes, we're doing really well, but why should we not be doing better than what we're doing? I think fundamentally the issue has been the specifications in the rules, right? How some of the market risk is calculated, how some of these players are being penalized for operational risk. Banks that have diversified are actually bearing the brunt a little more than they should be, and they argue, look, we've actually spent several years trying to diversify our revenue sources, make it more fee-reliant. That can't be punitive. Like, you can't punish that. Similarly with market risk, how some of the prime business will be affected based on how that risk is calculated. They have some very specific and very serious concerns about that they're trying to undo. You add a little bit more of risk weight to the mortgages and the consumer loans, that's different. But some of the ways in which they're handling operational risk and market risk, they have serious issues with that, and that's where most of the back and forth is happening.
All right. Sri Natarajan, thanks so much for joining us. Sri Natarajan, he covers all things Wall Street, Goldman Sachs, JP Morgan, all the big banks there for Bloomberg News. We had him in our studio, which is very cool. But again, that profit number, Kaylee, for JP Morgan is just staggering. They dominate in almost every single major business they compete in.
Yeah, it's going to be a big one. And of course, Paul, we're coming up on the end of the year here. We're just a couple weeks away from big bank earnings time again. We're going to find out just how well they're doing.
Just how well they're doing. All right, we're looking at these markets here. Quiet day, as one would expect. The S&P is up just fractionally here. The NASDAQ, same. So not much movement here. But we're going to have more coming up. More market starts in just a moment. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another.
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media.
Let's do it.
All right, you ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
I got a point! From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
What did you learn in the last 40 years about leadership in politics?
Well, I've been learning a lot about leadership for a very long time, observing it in others, recognizing what is needed to get the job done. And I always define it in this way: know your why. You have to know why you're doing this, because you will be under attack, this for sure. Know your why, know what you're talking about, know how to get it done, think in a strategic way, and then that's all up here. And then also connect directly with people. If you can show them how important what you're advocating is and what you know you're talking about, so they trust your judgment, and you have a plan, you will have followers. You will be a leader.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From from more than 120 countries. The moment news breaks, 24 hours a day. Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg. Top experts. Great questions.
All right, welcome back to Bloomberg Markets. Caroline Hyde joins me for the next 2 hours as we kind of make our way through this holiday shortened week, Caroline. It's not much moving in terms of the major indexes out there, but a lot of news out there.
It is. I mean, what, just in the last 15 minutes alone, the
Yes.
Apple Watch sales ban put on hold by a appeals court. I cannot wait to get back in touch with Mark Gurman about where he sees that particular company story unfolding. But really, there is still so much geopolitics at play, trade to be digesting, all of it, and its impact on the markets. Paul.
Yeah, we are seeing yields move, though. We've got the 10-year Treasury off about 8 basis points, 3.81%. Boy, it wasn't that long ago. We had the 10-year was trading north of 5% there. So big move in rates. We're seeing mortgage rates come down. Yeah. That was important for Kaylee Lyons as she's house hunting, and she liked to see those rates come down even more. Let's get a sense of maybe where these markets are going, because it's been such a move just over the last 7, 8, 9 weeks here. Big moves up in the equity markets, big moves down in yields. I'm not sure how many people kind of saw that on their bingo card. But Nancy Tengler joins us. She's the CIO of Laffer Tengler Investments, joining us via Zoom here. Nancy, boy, this move we've had over the last 8, 9 weeks has really been something to marvel at. What do you make of it?
Well, I love the bingo card analogy. Yeah. Never had much luck with that myself. But yeah, I think a couple things, Paul. We wrote a piece on October 31st that said opportunity in every difficulty. And at the beginning of last year, we wrote a piece that said, or of this year, that we thought investors were being way too pessimistic and that we expected to see the markets do much better than most thought. We don't do market forecasts for the year end, but we did say in the October 31 piece, we thought we'd see a rally, and not expecting this much of a rally, to be sure. I think you've got a lot of things going on. It's not just the Fed, it's, the money on the sidelines, it's creeping in, it's window dressing. But I do think that stocks, if you look at the multiple, you're at 15 times, 15.3 times S&P ex FANG. With FANG, you're at 17 times next year's earnings. That is not super lofty, and I think we have the opportunity to move up from here with some choppiness in the first quarter.
I always love, Nancy, your notes in particular. And I think back to sort of the October 31st note. I think back to some of the quotes you use of Winston Churchill in particular. You say, a pessimist sees the difficulty in every opportunity. An optimist sees the opportunity in every difficulty. So be the optimist, and I know you are one. What are some of the difficulties that you're going to be keeping a keen eye on as you try and assert some of the optimism?
Well, I love your Winston Churchill, Caroline, so I quote him at every opportunity. Yeah, so I think one of the biggest concerns is inflation licked. Now, we know that the core number, the PCE number, has been coming down, but the sticky inflation number per the Atlanta Fed is still very high. And if you look at historical numbers back in the 70s and period where we had inflation restart, it's pretty positively correlated. Now, we're at the turning point, so whether or not that happens remains to be seen. But I think the other thing I'm quite concerned about is the Red Sea. And if you look at the good news in the PMIs, it's that delivery times have come down, but they're about to go up if we have to continue to go in alternate routes for shipping. So that's something on our radar. We're not concerned about earnings. We think margins are going to continue to improve. That was the good news story in the second half of this year. And so we think that continues. Managements have done an excellent job because most of them refinanced before rates went up. But, I haven't been particularly complimentary of the Fed, and they can still screw this up, in my view.
We are going to go into Red Sea in a moment, but I want to go back to some of the expertise that I'm so pleased you bring to our technology shows on the odd occasion that we're lucky enough to welcome you on. Nancy, you are someone who you might not think that the Fed's always doing that great, but you are pretty focused on certain leadership, and you've called out certain tech companies that have done particularly well in this environment. What of breadth in technology? You've been trying to say, look, it's not just all about these 7 killer stocks. There are others to be had. Do you still believe in that area being able to lead us higher for 2024?
I do, Caroline. The total addressable market for generative AI, cloud, digital transition is enormous. It's in the trillions of dollars. And so the question becomes who are going to be the lead, or who are going to be the survivors and the thrivers in this environment. We still think you want to own a couple of the FANG names, but there are much broader places to be focused on. Some old economy tech like Oracle. I don't know. I call Broadcom the poor man's NVIDIA. That is one place that we think still has plenty of room to run. We've started looking at a few new names, which I can't talk about because we're in the process of buying them, but I shortly talk about them. And I think you want to remain overweight this group, but we are also overweight industrials. And our big move at the end in the fall of 2022 was to add to consumer discretionary and tech. And those two have been 2 of the 3 best performing sectors this year. I think there's still opportunities in consumer discretionary as well.
Well, that's kind of where I wanted to go, Nancy, because it may surprise you to find out that I am not long that magnificent stocks, 7 stocks in 2023. So what do I do in 24? Do I try to chase those names, that big tech growth, or do I don't know, try to find some value somewhere else?
Well, Paul, you know what's so interesting is that if you look at the valuations compared to the 90s, and I think when I was on with you last, Caroline, I talked about that this market is an analog, or the 90s is an analog to this market. A lot of similarities in terms of inflation, high rates, an inverted yield curve, a soft landing, a war. And those valuations, I mean, all you have to do is look at Microsoft. It was trading at the end of the 90s at 50 plus times peak earnings, and it's currently at somewhere between 28 and 30 times forward earnings. These are not peak earnings for the company. So I think there are spots. Like I'm less enamored, though I know people love Meta. It's not one of our top picks, but would I continue to add to Microsoft here? Or Amazon is a name that we think is probably our top pick in that space for next year. Yeah, I think you use weakness and you just be disciplined. You don't chase any of them. The last thing I'll say is if you look at NVIDIA on a forward multiple basis, it's pretty cheap compared to what you might think since the stock has doubled. It's in the the mid 25 range. So I think those are all names that you can use opportunistically to round out holdings. Don't chase anything because the market will pull back, we'll get a correction, and that's when you step in and buy with both hands.
I wonder if a correction, Nancy, to the extent we want to buy with both hands at some point this year, will it be earnings based? I mean, you look at the S&P 500 earnings expectations are up about 12 to 13% for 2024. It feels a little frothy to me. Do you think there's material earnings risk in this market?
Well, I think the dollar's coming down, so that will help some of the multinationals. I think it will continue. I mean, it has come down. It will continue to come down. But I'm not sure about that because if you look at the companies that we've just been talking about, they have not only been guiding up, but they've been expanding margins. I mean, there will be companies that miss earnings, and they will be punished. Oracle just missed guidance, and so it was punished, and we used that as an opportunity to add to holdings because we think long-term, these are the companies that you want to own in a slowing growth environment and a tight labor market where technology spend is how companies get productivity. So I think we may be surprised, but remember, and you know this as well as I do, analysts are wrong to the tune of about 2/3 of the time each quarter. So we know to the upside and the downside. So I think what you have to just be ready to do is you have your list, and if they do disappoint, you step in and you add to those names.
Nancy Tengler, it is always such a joy to have you on the show with us, CIO of Laffer Tengler Investments. Wishing you a wonderful new year, and I'm sure we'll be having you across our network soon in January. Meanwhile, though, and Nancy was just spelling out to us, one of her key concerns, her risks, is what's happening in the Red Sea, is the issue of inflationary pressures coming from these boatloads of goods having to go an awful lot further than initially priced in, and delays to delivery times. Let's dig into all of that, ultimately where we are in terms of some of the risks of traveling through the Red Sea at the moment, and indeed what it means for some of these shipping companies. We're pleased to welcome onto Bloomberg Radio and TV Brendan Murray. He's, of course, of Bloomberg, as is Gerard DePippo. And I'm going to start with you, Brendan, because, Gerard, you've done some great work on the economic impact of all of this. Brendan, I go to you as sort of our trade czar here. how much harder is it? Hapag-Lloyd, key shipping companies saying, look, hold on, we're still not going to be going through the Red Sea. Thank you very much indeed. Whereas we are starting to see from Immerse and other players that they are tentatively starting to cross it again.
Yeah, we see confidence slowly starting to look at the Red Sea crossing, sort of re-emerging. As you said, Maersk said that they are planning to reroute ships, as soon as it's safe to do so. We don't know how long it will take for it to be safe, but they're getting ready to change direction fairly quickly. Hapag-Lloyd, as you said, is saying it's still too dangerous. So in the meantime, what we're seeing is, just a steady increase of ships diverting south of the southern tip of Africa, and it bears watching. There are about 300 ships by our latest count currently making that diverted route. That's roughly 5% of all the container ships in the world. So it's not an enormous amount right now, but it's creeping higher, and it bears watching.
So Gerard, that takes us right to where we want to go. I think the economic impact for that part of the world, and maybe even globally. I looked at the map. That's a long way to go. I mean, you're taking a ship, and this isn't just like a around-the-block kind of detour. This is a huge detour. How do you think we might feel it in, I guess, the European economy and abroad?
Well, our view is that the economic impact globally is probably going to be fairly limited. So for Europe, for example, something like 5% of the total cost of oil from Saudi Arabia to Europe is for shipping costs. Shipping costs have gone up, but they are much, much lower than they were a year or two ago during COVID.
Right.
On the inflation side, you actually find that shipping costs are actually a pretty small share. It's like less than 0.1% of the Eurozone inflation CPI. So our view is that apart from supply chain issues like inventories and lag times, the inflationary impact is probably fairly limited, mostly because this is happening at a time where there's more capacity than there was, say, a year or two ago.
And Gerard, on that note, have you sort of just thought through which areas of the inflation pressure hurt the most? Did you think oil seemed to, of course, be the knee-jerk reaction, but ultimately, is that the right place to look for inflationary pressure, or is it more going to be creeping into some of the goods that are currently being brought through the Red Sea?
So based on market response so far, it's fairly limited on the energy side. Oil's up a few dollars, but that's not actually that much. My guess is that over time, if this lasts for, let's say, weeks or months, where you're going to see it more is on supply chain. So having to build up inventories, waiting longer, not having, people were getting used to having shipping be sort of normal again, right? Mm-hmm. And now this is pushing it marginally back towards abnormality.
Just real quick here, Brendan, the U.S. Navy's in that region. Are they having an impact?
Not a huge impact just yet. There are still plenty of ships, tankers, and cargo vessels going through the Red Sea. On average, there's about one attack per day. But when you're looking at dozens of ships going by, the percentage of ships that are getting attacked is not very high. So we are seeing cargo continue to flow through this region, but if we continue to see an inability of the navies in the region to prevent these attacks, then we may continue to see this sort of drawn out, weeks turn to months, and the conflict spreads through the region. If one of these drones, if a serious fire catches on one of these big ships, then you're looking at a different scenario. But at the moment, it seems fairly the impact of the Navy's protection seems fairly limited.
All right, folks, thanks so much for joining us. That was a smart discussion. We appreciate getting some of your time. Brendan Murray, Gerard DePippo, both Bloomberg News, bringing us the latest reporting from the Middle East here. Coming up, we're going to talk a little crypto. Bitcoin up 150% this year, and according to CoinMarketCap.com, the total global crypto market cap is currently $1.68 trillion. We're talking some size.
Smaller than Apple, though.
Smaller than Apple, that's right. Yeah, put that in perspective, because perspective is everything. S&P 500 really unchanged on the day. We'll have more coming up. This is Bloomberg.
politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to Bloomberg Markets. We are going simulcast across TV and radio today. Paul Sweeney, Caroline Hyde here for a couple of hours with you up until 2 p.m. I'm looking at, well, crypto is the alternative investment of choice, it would feel, for 2023. Look, we know that the risks are often tied up with some of the rewards, but extraordinary performance, particularly if you're looking at the crypto hedge funds this year, Paul. On average, they returned 44% this year. Best among 29 strategies tracked by Bloomberg. However, they massively underperformed if you just bought Bitcoin and hodled, as they say, in the market. Let's discuss it all. Bloomberg's Shanali Basak. And 44%, look, it's decent reprieve and bounce back after what was significant loss the previous year. Well, why are they underperforming like the 150% rally that we saw in Bitcoin more generally?
Yeah, it is pretty incredible. If you just bought Bitcoin, you would have been up more than 150, 160%. But if you invested in any of these funds, they were only up about 44% on average this year. You would have been better off even investing in the Philadelphia Semiconductor Index, frankly. And so it's pretty amazing to see how crypto has done so well. Now, all funds are not created equal. Remember, last year, we've seen hundreds of funds shut down in the wake of a lot of the crypto crash. We've seen a lot of people had money tied up on either FTX or invested in things like Luna. But this year, that rebound in cryptocurrencies, to your point, it is better than most hedge funds, depending on what you invested in. I mean, there was one altcoin firm that Bloomberg had reported on that was up almost 270%. So there's a lot of, and again, nascent asset class, as you would expect, a lot of dispersion.
Dog witch hat.
Yeah,
or whatever the latest alternative coin of choice is.
And it's interesting, you know, one of the people we spoke to yesterday, for example, was Nick Carter of Castle Island Ventures. So we talked a little bit to him about what his picks were, because we get a lot of heat here at Bloomberg for focusing so much on Bitcoin and not talking enough about places like Solana and Ethereum, where there are a lot of fund managers that see a lot of promise going into next year because of how people are building on these chains.
Well, the only thing I know about this whole crypto space is what I learned from reading Mike McGlone's research and talking to Mike McGlone from Bloomberg Intelligence, because he knows what's going on. But there is a monitor on the Bloomberg terminal, CRYP, that lists a lot of the cryptocurrencies. So if I'm a hedge fund focused on crypto, I buy Bitcoin, I guess I buy Ethereum, but there's a lot of other stuff out there too.
Yeah, and you can get really wonky if you want to about it. You can sit there and start buying different types of coins, but you could also start to arbitrage. People have arbitraged the futures difference between, because remember, futures is now, the Bitcoin market is a derivatives market as well. So you've had people who have been arbitraging the futures market to the current spot market and levering up those trades, for example. Futures allow you to go short a little bit if you want to, but I mean, that would have been a terrible trade if you chose that to hedge your exposure this year. There was a lot of uncertainty before the exuberance that we've seen in the last couple weeks, really, couple months, for that Bitcoin ETF, which, by the way, we haven't seen. The other thing that was interesting that Nick Carter had said yesterday to us in an interview was that he actually thinks that this kind of melt up in Bitcoin risks a correction as well. So it sets you up really interestingly to see how much it's already been priced in, that exuberance around the Bitcoin ETF that really has its next big deadline on January 10th when you think about whether it can start to approve new assets or not when it comes to.
Buy the rumor, sell the fact. So maybe brace for early January and people to be perhaps getting out of Bitcoin. But then finding alternatives.
Exactly.
The problem with crypto, and I say this with love, is that they're very hard to take seriously when they're naming Pancake Swap cake token, and that's up 50%, and they're at 900 million sort of market capitalization. When Bonk was all that anyone was talking about in terms of particular altcoins, but they have a lot of the time serious applications, use of case. What are the protocols? What are the tokens that some of Dan Moorheads of this world or long-time crypto investors are thinking are seriously going to be solving real-world problems right now?
Well, one thing that I think about a lot is part of this was an answer to a broken payment system, and that has been a very challenging thing to be solved through blockchain. One thing that will be interesting into next year is the way you do it on Bitcoin is that there's this layer called Lightning, and now there are alternatives to Lightning that could make it easier to facilitate payments, and we have seen in recent years fairly significant. I mean, if you want to pay for a Starbucks coffee with Bitcoin in El Salvador, Lightning is what helps facilitate something like that. So there are use cases. It's not that in the United States you see that as popular as you do in areas that probably have more broken payments infrastructure than we do here. Everything's online here anyways. But those kinds of applications are a good example of how you see real-world problems being solved. But you know, the funny point that you make, I think back a couple of years ago, you might remember when Mark Cuban really worked to integrate, was it the Shiba or Dogecoin when it came to the Mavericks purchases, and he had said to me at that time, it's just fun.
Yeah. Don't take it too seriously.
Can fun be an investment thesis? I mean, it's paid off in some of these regards. So, and he's one of the more successful investors, particularly in venture in the world.
Yeah.
So,
but it's funny, on the flip side of that, maybe it's Jamie Dimon. You still don't have an acknowledgement, much less a vote of confidence or support in, I guess, broader crypto, but certainly Bitcoin.
But do you need it? Do you need it from him at this point? When you have BlackRock Fidelity stepping into the ETF market, it's not surprising to see a banker say that this payment system...
There's disruption of what I'm quite good at.
Totally. And so when he says things like that, but also is working on things like their own blockchain projects, it doesn't seem like an entire dismissal of the blockchain model as much as it is a criticism of Bitcoin in and of itself, coming from somebody who competes with this technology.
So Nick Carter was perhaps giving us a little bit of rub, as many should, that look, stop focusing on the OG that is Bitcoin, even though MicroStrategy does that, but think about some of the alternatives. But to go back to the OG for a minute, we do have fundamentals in place, not just the ETF, but talk to us about the halving as well that everyone's bracing themselves.
Yeah, and we talked to him about that as well, and that is something that there are a lot of investors that do believe, Mike Novogratz being one of them, that is something that can start to change the supply-demand dynamics between Bitcoin, create another catalyst into next year. So this Nick is a little more skeptical.
Halving, H-A-L-V. So they're going to cut in half the number of Bitcoins out there? Is that kind of what they're saying? Or
the amount of rewards for mining each one.
But remember, here's another thing too, the amount of rewards, but the way that Ethereum has worked as of late is already different than that, which is kind of why there's this debate that maybe Ethereum has been a better way to, let's say, earn yield from a crypto asset through the process of staking rather than this halving process that you're seeing in Bitcoin. I think it's an interesting monetary debate, if you will, I guess, in the crypto community. I will say something else that is kind of interesting, Caroline. You were talking about practical use cases. On one hand, you've seen Bitcoin be one of the best performing asset classes, really in the world this year. But on the other hand, you do have camps of people in the crypto community that I've heard speak to me about how they're distancing themselves from Bitcoin, from crypto.
From an energy perspective? Or?
There's an energy dynamic to this, but also this idea that there's a lot of uncertainty about where it fits into the financial ecosystem, and they want to focus their energy on the blockchain infrastructure more. And,
They don't like the actual asset class, but they like the underlying technology. Gosh, if I could be paid every single time
you
someone
heard
said that.
Exactly. And you are seeing, I think when you look at all the different types of crypto assets out there, and even the infrastructure behind them, there's a lot of debate this year around Coinbase, for example. How profitable can Coinbase be when you have an ETF infrastructure? When you start to think about what all of the pieces of the pie mean in terms of how the digital asset infrastructure is recreating the financial community to some degree, blockchain, Goldman Sachs would have said a year ago that blockchain was one of the most revolutionary technologies that could change the way that they transact.
Now it's AI.
Now it's AI.
Yeah. And weight loss drugs. All right, very awesome stuff. I mean, it's just, you never know where this discussion of crypto is going to go. Sonali Basak, appreciate getting some of your time. She covers all of the financial stuff for us, all of the Wall Street stuff for us. And we're starting to see just a little bit of embrace of crypto on Wall Street, but not as much as one would think. Coming up, we're going to talk media. That's kind of right in my bailiwick. Yes. 2024, a lot of folks are predicting maybe some M&A here. Some of these companies, whether it's Paramount or Discovery, Warner Brothers to Discovery, maybe they'll do some deals. Maybe some of the big tech companies will once and for all jump in and buy some of these media assets. So we're going to break all that down. Coming up with Simone Foxman from our very own Bloomberg's Simone Foxman. And then Ian Whitaker, one of the really smart voices in media. He's based in London. I've known him for a long time. He's been an analyst in the city of London for a long time, covering the broader media space. So we're going to get those folks together and talk about media industry 2024. That's all coming up. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
All right, welcome back to Bloomberg Markets. Caroline High, Paul Sweeney We are broadcasting, we are simulcasting actually live from the Bloomberg radio studio in New York City. A quiet day on a trading perspective, as one would suspect during the week between Christmas and New Year's. Looking at the S&P 500, really unchanged on the day. The Dow's up about 0.2%. We are seeing a little bit of performance. Russell's up about 0.25%. So continuing that outperformance we've seen over the last couple of months by some of the small cap stocks. Definitely see some movement in the yield space. We got the 10-year Treasury off about 8 basis points, 3.81%. WTI crude oil off 1.7%, $74.30. And we'll continue on our crypto discussion here because we got Bitcoin. That's up 1.5% to just under $43,000 per token. So we got some movement a little bit there in crypto. So we'll keep talking about that.
Yeah, we'll keep talking about it. But I mean, the fact that we are still seeing overall any sort of narrative being built into what might be the ETF by January, I thought we'd talk that to death.
Yes, absolutely. All right, let's talk a little bit of media here. 24, a lot of folks in 2024 think there's going to be some movement here because these business models for the media companies are really just going under a unbelievable transformation as they pivot away from, the pay TV business, cable television, satellite, more to a streaming business. And not all companies have survived, will survive. It's a big, big change, and we're going to get a little bit smarter on that. We're going to do that today with Simone Foxman. She covers, she's from Bloomberg News and Bloomberg Television and Bloomberg Radio. She does it all. So I want to start with streaming. Netflix makes money on streaming, but I'm not sure anybody else does. What do you think, Simone? What's the report
It's an
show
enormous capital cost. And, you look at Amazon coming out yesterday and telling its subscribers to Prime that it's going to actually start charging them money if they want to avoid seeing ad revenue. It's just a challenging business model. And, markets were very pro building the streaming service, building the number of subscribers, and they seem to have kind of done an about face recently. And so everyone who's, I guess, not Netflix has really struggled to make their streaming profitable. And
And they've made it, it's hard if you don't have massively deep pockets. Now, Apple has massively deep pockets. So too does Amazon. Where are we starting to see sort of ultimately the war continue, though? Because everyone was saying, look, just keep on building, keep on throwing money at it because ultimately it's a race for market share. Are we still seeing that sort of be the narrative of choice?
Yeah, you mentioned Apple there. Bloomberg Intelligence out with a really interesting note earlier this month, expecting that Apple will lose $6 billion in 2024, in part because of those content costs. There seems to be a definitive move towards sports. We are going to watch the NBA negotiations for the next round of rights there. We're expecting Apple, Google, Amazon will all be at play. Amazon, for one, looking as well potentially to invest in Diamond Sports, regional sports network, bankrupt, etc. So that could be somewhere where we see them try and differentiate themselves. But again, the move seems to be towards streaming. It's just who can capture the biggest share at a doable cost. And the tech companies have deeper pockets than everybody else.
Boy, we were just talking about the value of sports, and it's just some red headline across the Bloomberg terminal. NBA approves Dallas Mavericks sale to Miriam Adelson, that is from the gaming Adelson family in Vegas. So again, a big news, big dollars, and that's kind of what we're seeing in sports, no doubt about it. Let's bring in someone I've known for a long time and one of the smartest voices in the global media space, Ian Whitaker, managing director and owner at Liberty Sky Advisors. He's based in London. So, Ian, let's start with kind of the number one issue, I think, for most investors that look at global media. It's like, what's the new world order? It's streaming, I guess, but who are the companies that can survive this? How do you think this is going to play out in 2024?
Yeah, well, thanks very much, Paul, for the very kind words. I think you have to go back to the fundamentals here. If you look, who's going to be the ultimate winners of this game? I think it is going to be the tech companies, simply because they have the deep pockets that the other players do not. I think what you're going to find is that some of the players like a Disney, a Comcast, probably also a Warner, will have to now stay in the streaming market, because essentially those companies, what they made was a big strategic mistake several years ago, which was really to go all in on streaming. And I think the consequences of that are still rippling through the market. I think there will have to be consolidation. that will eventually come through. I think Warner Paramount deal possibly gets done in the next 12 months, so I'd be slightly longer with that. But I would say in terms of who has deep pockets, it's really the Apples, the Amazons, and so forth. One thing I would say, and I think this is important because all these streaming companies, and I think it's one of the other big mistakes they also made as well, they looked at the world from a very US-centric point of view. And they thought that essentially, the dynamics of what would work in the US would work globally, and therefore it made sense to go after big subscriber numbers globally. It doesn't. Europe has structurally lower penetration, structurally lower ARPU than the US market. And if you look what's happened with the Premier League rights, for example, we're talking there about the NBA rights and what's happening, none of the tech companies actually sort of bid aggressively for the Premier League rights in the UK. The dynamics, the economics of it just don't work. So I think what we're going to see here is increasingly with streaming that effectively there's going to be the realization that different models work in different geographical markets.
So, Ian, I've pitched every tech company, basically every media company that's out there for 25 years and gotten no bites whatsoever, really. I'm wondering if they can just stay on the sidelines and let some of these media companies just beat each other over the head and then pick up the content on the cheap. I'm just not sure the appetite for Silicon Valley to come into Hollywood.
Yeah, I think that's a very good point. If you look at the various maneuvers that have gone on, Apple essentially, yes, it's got into films, so it's been very selective. Amazon bought MGM, but it hasn't been a major push that has come through. I think an interesting one would be what Netflix would do. I mean, for me, sort of Netflix joining the Paramount acquisition talks would make sense for Netflix. There's a number of of areas that a tie-in there would actually help out on things. The analogy I've used in the past, and I've been using this for several years now, is that what you've got in streaming is, if you want a historical analogy, it's sort of akin to World War I. That what you've got is that you've got the major media companies, as you say, essentially bashing each other over the heads, really exhausting themselves into a state where, quite frankly, it's very, very hard to actually make major gains and actually sort of win convincingly. And then if you look at actually what happened in World War I, the Americans came in and effectively sort of won being the last players in the game. And that's essentially where we are with the tech companies now. That the Apples, the Amazons, the Googles and so forth, particularly in the US market when it comes to sports, they really now sort of let everyone else exhaust themselves and can now just march in and really take up the spoils. So I think particularly in the US, I would say the tech companies you would say would be the ultimate winners. I think when it's globally, I think the picture is a lot more varied. Europe, for example, I think the free-to-air broadcasters there, there are different viewing habits. There's different ways of paying for pay TV and so forth. But I think most of the major established media companies really made a massive strategic error, and it's something I've been saying for several years, in going full on into the streaming model, which quite frankly destroyed a lot of the infrastructure that had worked so well for several decades.
Okay, so playing devil's advocate, you sit down with a CEO of the legacy media companies. Many of them would say, look, from a standing start, I've now built a business that's several billions. Yes, you might not say streaming is working, but I've managed to make it a significant revenue driver. What would you say to that?
Well, it may be a significant revenue driver, but from an analyst, from an analytical standpoint, financial market standpoint, what people care about are profits.
Yeah.
And you look at on a quarterly basis, you've got Warner, which has made a slight profit. Netflix, as you say, is the only one that so far has managed to make a consistent operating profit moving forward and so on. But its free cash flow isn't particularly it's okay, but when you look against its peers, definitely not huge and so forth. I think you've got several ways you can approach this. You can say, look, we made a fundamental strategic error here in really going full on into streaming. We now actually have the courage to step back and say, you know what? Maybe we actually need to exit this game. For me, the smartest player the smartest media company, when it came to what happened with streaming, was Sony.
Yeah.
And Sony decided we're not getting involved. We're just going to license our content to everyone else. And effectively, they were the arms dealer.
Ian, to use that analogy, though, I've heard that a lot of late. Be an arms dealer, be an arms dealer. A lot of these companies don't want to be arms dealer. They don't think that it's lucrative enough. They don't want to just be supplying content. Why would they not want that?
Well, I think a lot of it is essentially they've been invested in the streaming pattern. They've got, as I said, they've gone down for several years now down this route. As you say, they've built an infrastructure. In many cases, they realign their companies really to focus sort of primarily on the streaming operations and so forth. It's a very, very hard job for companies to step back and say, you know what, maybe we made a mistake here. Maybe we need to realign again. Shareholders don't like it, investors don't like it, simply because it raises questions about the quality of the management and the decisions they've taken as well. I think one way to look at this is to say, flip it round. What exactly is going to change with the streaming model that will suddenly make it a hugely more profitable model? And the question is, when you look at things at the moment, you can't really look at anything that will say there's a real game changer here.
All right, well, here's a real game changer. Bloomberg Intelligence is out with some research saying with around $6 billion in estimated 2024 losses, Apple TV Plus will lose 80% more on its streaming business than Disney, Paramount, NBC, and Warner Brothers Discovery combined. So you talk about an entity that can spend like crazy and just let everybody else kind of fall by the wayside. So, Ian, I got to ask you, when you talk to institutional investors, why is anybody buying any of these big media names? I just don't get it.
Well, I think what you've got I mean, it's a very good question. I think there are several elements here. If you look particularly at the US media companies, they do have other assets that are performing well. Disney, for example, theme parks. Theme parks across the sector have done very well. They do have very, very good historical content assets. And this is to go back to the point before about being the arms dealer. What you've got here, if you look, for example, in terms of streaming, it's always the old shows that seem to perform the best. The new shows effectively are they come out, they get lauded, and then they get forgotten often within 6 to 9 months.
We're all back to listening to Suits again on a different type of device.
Exactly, and that's the whole point. And I think for what you've got for many of these for many investors here, is what they're thinking is, at some point, it will all come out right. And the problem becomes with that is that it doesn't come out right automatically. You've got to take the companies and the managements, and they've actually got to take active measures to make sure that they go down in the right route. And I look at certainly I look at the legacy media companies, and I look at what they're doing at the moment. I think, Warner Discovery, I think, they have started to sort of go on the right route by saying, okay, we won't let the streaming tail wag the WBD dog. I think Comcast has its broadband business, and that's different. I look at Disney, and I think strategically, and in terms of some of the decisions they've made, they've really been pulled in several different directions. And I look at Paramount, and I just think as an independent sort of entity, how does that actually sort of survive in certainly in the streaming anyway, how does it survive over the longer term? Personally, I also think there's a question mark over here over Netflix. Yes, Netflix has done very well. It's making profits. It's got a global presence. But quite frankly, when you look at his historical content, it doesn't really have that much, which is why I made the point before about maybe Netflix looking at Paramount. And again, I go to this sort of total addressable market picture. If you look according to Kantar in the US, SVOD penetration is probably around 85, 86%. If you look at Europe, there are clear signs that is, even in the most markets, it's flatlining around 65% in somewhere like the UK. Also as well, and this is the other thing that gets missed with these streaming models, it's not just about subscriber numbers, it's about the average revenue per user. And that is much lower outside the US. So again, you've got those dynamics as well.
All right. Ian, great stuff. Thanks for breaking it down for us. Ian Whitaker, Managing Director and Owner at Liberty Sky Advisors over in London, been covering the media industry for decades. He's got great perspective. Appreciate getting a few minutes of his time. I think media investors, that's a tough time making a bull case for media stocks here. You're hoping for, I guess, some M&A, some consolidation. All right, coming up, we're going to get a little technical trading, zero-day options. Wall Street quants warm up to zero-day options amid trading boom. That's all coming up. We're going to have some smart voices on that. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
City, in London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Welcome back, Bloomberg Markets, across TV and radio today, simulcasting Caroline Hyde, Paul Sweeney, to dive into what I thought was not hot, and now hot again, and maybe a bit of both, because zero-day options. Cast your mind back, if you will, to Wednesday, the 20th of December. Feels a long time ago now, prior to Christmas. But there was a lot of hand-wringing that sudden sell-off towards the end of the day's trade, where we finished down by about 1.5% on the S&P 500, was in large part to blame for these flashy new zero-day options, where basically, well, you have 0 days until expiration. Why, then, are they now being liked by some of Wall Street? To get the facts, Jess Menton's with us, so is Abigail Doolittle. And, okay, context, Abigail, you are our options guru. What is a zero-day options? And why they all got the fandom of Citi and JP Morgan right now?
So the interesting thing here is 0 days to expiration options. They're basically options that last for 1 day. So by the end of the day, any premium you pay disappears. The really interesting thing is they've essentially been around for a long time. I was talking to Steve Sosnick over at Interactive Brokers, and he was saying, options, you can make the case that they go all the way back to 1973, but they surged earlier this year. So first they went from being, I think, a Monday, Wednesday, then they added a Friday. In any case, earlier this year, or late last year, they added both Tuesday and Thursday. So these options are available every day. And when they really became big was this previous February FOMC meeting. Powell either used the word disinflation or neutral, and the market loved it. It zoomed and then really primed a rally on the following day, February 2nd. But there was a jobs day on February 3rd. So all these traders figured out they could essentially hedge these 0 days to expiration options to hedge that event. And they've become big ever since. But it's just the fact that they were flooding the market since. As for institutions using them, it's probably pretty likely institutions were using them too, because at that point, apparently February 2nd, those were record volumes for options. Now you have to distinguish, are they using them to generate income, or are they using them to hedge, such as happened on that CPI day? More so, we think, for writing.
So, Jess, how do the market pros feel about this? I mean, Caroline was mentioning that was kind of blamed for a sell-off there at one time.
Well, it was blamed, but Elena Popina, she's one of our star reporters on the print side for the U.S. equities team. So she actually wrote a story about this. So she talked to SIBO, and they actually pushed back
Chicago
against
Board
that.
Options Exchange.
Correct. And so great story she put out after this. So she talked to them, and they went through the data that they had. So basically what it showed was that market makers were mostly long gamma throughout that sell-off that had happened last Wednesday. So meaning essentially that they were going against the prevailing trend and actually buying stocks as they did fall. So there's more pieces to this puzzle than just kind of pointing the finger. At least SIBO is arguing as far as what went on last week, Caroline.
Okay, so let's go with the vibe that they're hot. Are they going to remain hot into 2024? Like, what is the onboarding now? Have we sort of hit saturation point, Abigail, for who actually wants to be using them, either to earn, as you say, to write them, or indeed to hedge?
I think that they are going to probably stay pretty hot. They're a new tool in the toolbox, and institutions, sometimes institutions, it takes them a little bit longer to become comfortable with a certain tool, but it seems like a lot of these institutions are, especially from the writing standpoint. If you calculate the risk correctly, you can generate one-day income, basically, and that can, in an off way, act as a hedge for a portfolio. In terms of hedging for CPI day or jobs day, it's a similar situation. I mean, it's really a nice tool to have in the toolbox. Now, you know, there's been a big conversation this year about whether or not the VIX is dead, and if it is dead, is it because of these zero-day to expiration options? The VIX is not dead, based on everything that I can tell. They're two different instruments. VIX basically is, written on a 30-day basis. You know, the bottom line is you really would be challenging, maybe impossible, to use these 0 days to expiration options to hedge a portfolio, simply because of the fact that they do expire for the end of the day. So it really is more so in terms of writing for that generating the income, or to hedge on a single date event if they're, whether it's PCE, jobs, CPI, a Fed day, something along those lines. Now, may the craze go down? May the volume go down? Yeah, that seems like it's a possibility. It seems as though, that there's the hot new thing on Wall Street, and then the attention goes somewhere else. But it seems as though that they are here to stay.
So, Jess, does this mean, I don't know, to regular investors like me, does that mean these markets are going to become more volatile potentially intraday? Or?
But if you remember, this became so popular, especially during the meme mania, when you had stocks like GameStop, AMC taking off, especially early 2021, as Abigail knows as well. And so a lot of those options and those contracts can be used to bet on market moves or to protect against them, obviously a form of insurance there, as we call hedging. But this story by Lu Wang and Justina Lee that's on the terminal that we're talking about, Wall Street quants warming up to zero-day options amid trading boom, what they're looking at is actually, when you look at some of these bigger banks, so Citigroup, JP Morgan, also UBS, they're looking more into these systematic trades. So really with the rise in this popularity, so you have a lot of desks that are responsible, sort of this so-called quantitative investment strategy. So they're starting to build more trades around those types of options, because really, I think their clients are really interested in jumping on the bandwagon, especially when you're looking at these day options too, and then the derivatives contracts that go along with that. So now you have a lot of onboarding by particularly quants, and basically that's another sign of acceptance here. So you have not just the retail side here, but you also have more sophisticated traders that are jumping in on this too.
Just to that point, the fact that we're thinking that these might well be used as tools, decent tools in a toolkit. But take me back to sort of prior disasters. SIBO fought back against it, and eloquently so, as you tell us. But ultimately, if Wednesday's slight sell-off was in some part catalyzed by these zero-day options, do we worry about more market volatility in terms of actual disrupting? There's a stability at question here. Are we going to get 2018 Volmageddon again?
Well, the big thing is liquidity, right? Because at the end of 2018, the big question was liquidity. And at that point, that was when the Fed was also paring back its balance sheet, which did add to immense volatility. And if you remember covering that, I was there that week of Christmas, and that's when markets bottomed on Christmas Eve. But at the time, we did not know that. So if you fast forward now, part of the reason why a lot of these more sophisticated clients for some of these big banks are getting in is liquidity. So a lot of these strategies using at these zero-day options, especially getting out of trades so quickly compared to what they would have been used to be able to do. They're using it for basically looking at these low-cost bets, if you're looking at volatility, to even portfolio diversification. So when I'm speaking with my clients, they don't necessarily think we're headed toward Volmageddon, just given where the VIX has been trading. And a lot of even technicians, I know that Abigail also talks to a lot of CMTs as well, but Mark Newton over at Fundstrat, when everyone wants to bring up what's wrong with the VIX, is the VIX broken or not, but usually when he sees markets either kind of churning sideways and getting closer to records, to him it makes sense to see the VIX where it is currently.
So Abigail, some wise guy in my chat group just kind of asked the rhetorical question, why can't we have like 1 hour options? I mean, if we're going to 0-day options, I mean, I guess anybody can write a contract with anybody else, I guess.
Well, that's an interesting question, but I want to return to the idea that these 0 days to expiration options have essentially been around forever. They just used to be called expiration days.
Okay.
So, you know, and so it's an old product that's being repackaged in some way.
Marketed. Who'd have thought?
Who would have thought? And it's interesting that Jess was just bringing up Volmageddon, because that was one of the fears when, after that big volume day on February 2nd, ahead of that jobs day, after the FOMC, when people were going nuts on these things. But one way to look at it is, it's not that the casino necessarily becomes riskier. There's just more tables, more people are able to play. And in fact, one of the popular ODTE is a PM cash settling, and it takes away some assignment risk. So even on huge volumes, it's a safer way in some ways to, again, not hedge a portfolio, because to hedge a portfolio, you need something that's longer dated. If you're going to have a rolling hedge on a portfolio for something that expires at the end of the day, where any premium you pay in the beginning of the day disappears, but income generation, writing of it, and also to hedge on those particular dates where you're willing to do that. It's interesting, though, something that Jess was bringing up from the article, and I'm not sure whether or not this is the case or not, but if some of these big banks are writing packaged derivatives that then are involved around these options, I don't know enough about it to have a big opinion, but to me that sounds as though there could certainly be some risk, because whenever a big bank is putting together a derivatives package, it's not for the customer, it's for the bank. They're trying to generate income. So, you know, I'm thinking about these derivatives that a lot of retail people would be sold years ago, where, you know, you're betting on the SPY going down, the NQA going this way, and at the end of the day, often those bets don't work out. But it seems as though if these options are somehow putting in other derivative plays that have a longer term, it could be problematic.
House wins. We thank you so much. Always, Abigail Doolittle, just mentioned our minds are slightly boggling, but we really appreciate the options chat. Meanwhile, the market is flat as a pancake. That's your technical term right now, Paul. 0% move for the S&P and the NASDAQ. This is Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
This is Bloomberg.
Josh, that's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Like, please, like, really actually tune in. I desperately need an audience.
The island emerged emerging as a flashpoint between the U.S. and China. Taiwan's presidential election is drawing global attention.
Taiwan is an elephant in the room.
After the Biden-Xi Jinping summit,
we had some pretty tough talk.
Bracing for potential war scenario.
As voters head to the polls in January, Bloomberg takes a close look at the candidates, the issues at stake, and what it means for the world. In case you missed it, watch Taiwan Decides, a special report tonight at 9:30 Eastern. Bloomberg, context changes everything.
December the 27th, welcome to a simulcast, Bloomberg TV and radio. Paul Sweeney, Caroline Hyde. It is a joy to be back in the seat for a couple of hours and really sort of talking all across the markets as it stands. And let's just dive in on those markets, Paul, because boring. Are we surprised?
That's okay. No problem after what we've done so far this year.
We are currently just flat entirely on the S&P 500. We're less than a point move, just slightly to the downside. But remember, we're still in a hair's breadth of a record high. So maybe people are just playing calm as we head towards the end of the year. And the NASDAQ also completely flat. We're up just 1 point on the day. We're currently seeing the Dow, a little bit more activity, up 0.2%. But let's dive into what's happening on the Russell. The small caps, once again, managing to pull ourselves up. We're up about 5 points, but still that's only 0.25%. Keep an eye on the VIX. Is it dead? We were just talking about that with Abigail Doolittle, but it's off by about 0.5 point. 12.5 is where we trade. Brent crude is where some of the activity is, though. We're off by 1.5% on Brent, a little bit more if you're looking at the New York contract. All of this, of course, regarding geopolitical tensions, particularly around the Red Sea and Israel-Hamas. But for now, we can go more broadly across the markets with Callie Cox, U.S. investment analyst for eToro. Always a joy to have her voice on days such as these. And Callie, ultimately, where are we in terms of market exuberance? We're expecting probably a little bit of just sideways trading as we come towards the end of the year. But what a year it has actually ended up being. Certainly for the NASDAQ at the first half of the year, the exuberance around AI. Can we vindicate these valuations if the Fed doesn't cut as soon as we anticipate?
Yeah, well, investors are optimistic, no doubt about that. I wouldn't call them exuberant or euphoric just yet. I mean, one thing you can look at is high cash allocations and the fact that many investors are still uncertain about the future, so they'd rather get that 5% yield than, take the needed risk at the moment. So I look at sentiment, it's improved a lot, clearly. I mean, the S&P is up, I believe, 15% since the end of October. You're going to get more optimistic investors with a move like that. But at the same time, there's still a lot of skepticism out there, so I think the mood is healthy.
Callie, we've been calling out over the last several weeks how it seems like the breadth of this market has improved pretty significantly, whether you look at the SPW, the equal-weighted S&P, or whether you look at the Russell 2000. They've actually outperformed over the last 8-9 weeks. Is there more room to grow there, do you think?
Paul, this is one of the most encouraging parts of the move. We've seen so many stocks participate in a rally that was pretty unloved at the beginning. If thinking about, if we did bottom in October 2022, then, the ride-up, most of the ride-up we've seen has been carried by bigger, large cap stocks and tech stocks. Which isn't a problem. That's usually how bulls start. But at the same time, you do want to see more of that participation. So thinking about the Fed, thinking about how the market is factoring in rate cuts next year, there could be a little bit of disappointment there, especially because the move we've seen in more cyclically sensitive stocks has been especially strong. And we're not entirely sure that the economy is fine yet, even though things look good right now.
I mean, there's some great analysis that have been talked about, so-called bad breadth, and the fact that it has been these few AI euphoric stocks that have led us higher, even though they haven't really been leading us quite as much in the second half of the year, Callie. But if we are going to go broader, if we are going to be looking, people are assessing the small caps, the Russell 2000, is it the right time to be rotating, or do we need to wait until that first rate cut, really?
Well, I think it's a matter of pace here. We think it's a good time to rotate into cyclicals, but we advise doing it slowly. Really thinking about where we are in the economic narrative. Of course, we're getting solid jobs numbers. We're getting good-looking economic data. The economy looks fine for now, but there's still a lot of pressure on the economy, and there still could be a lot of pressure, even if the Fed does cut once or twice in the first half of the year. So we think it's smart to step into cyclicals, especially because they've been beaten down so much, especially rate-sensitive cyclicals like banks. But you still got to hold on to that quality risk and not dive too far into either side.
Hey, Kelly, any valuation concerns here after this big year-end run?
I think back to bull markets, how bull markets start, and you tend to see valuations increase at the beginning of bull markets. And I'd argue we're at the beginning of a bull market right now. So I'm not as concerned by valuations, especially because there's the expectation that earnings could catch up next year. We're looking at an entirely different market right now than we saw in the 2010s and even the 1990s. A lot of people like to make the comparison to the tech bubble because of bad breath. I simply think that this is a different looking market. Tech stocks are some of the bigger tech stocks, are some of the strongest on the market. We throw them in the quality risk bucket, so valuations don't concern me at this moment.
We were just having that exact hark back to the 1990s, of course, with Nancy Tengler a little bit earlier. Callie Cox, great to have you on. Thank you so much. US investment analyst over at eToro, really talking about some of the lack of breadth and indeed where valuations could take us into this new bull run. Meanwhile, of course, this is a topsy-turvy economy. We are trying to understand really the resilience of a consumer, the resilience of a US economy. And let's talk therefore about sort of some of the companies that have failed of late. Bed Bath & Beyond, Pyrex, Party City even. Some of America's best-known brands have declared bankruptcy this year. And after years of cheap borrowing, perhaps it was unsurprising as the Fed started to hike into an inflationary environment. But what does it mean going forward if we're thinking about some rate cuts? Have a listen.
Bankruptcy.
A stunning fall.
Major restructuring debt is piling up. Companies are filing for bankruptcy now at the fastest rate since 2020.
Bed Bath & Beyond filed this year, Party City filed, Vice Media, Instant Pot, and Pyrex. The list really goes on.
And by all counts, there's more to come. The stakes are high. Jobs are on the line.
Debt growth.
Credit crunch. Ouch. Debt defaults like this tend to come in cycles like in 2008.
We're in the midst of a serious financial crisis.
Or the start of the pandemic when Washington stepped in, slashing interest rates so that companies on the brink could get cheap money.
We saw company after company taking on more and more debt.
All this access to debt bought companies time, but it also kicked the can down the road. Nobody knows how long the pain will last.
We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level.
The record surge in interest rates is at the root of the issue. Global companies have borrowed more than $500 billion of investment-grade debt since the Fed's rate hikes began in 2022. The vast majority of this was heaped onto U.S. balance sheets. And despite the high borrowing costs, debt continues to grow.
It's really been building over the course of the last year. Interest rates have increased, cash flows have declined.
By mid-2023, blue chip names saw their borrowing costs rise by more than double to an average of 5.6%, while junk-rated companies were paying 8.7%.
With rates potentially staying high for a longer period of time, we could see a longer cycle that may not necessarily be tied to the macroeconomy.
The problem is, in part, that this is a little bit by design. The Federal Reserve wants to slow down inflation. Interest rates were kept higher for longer than a lot of economists and people on Wall Street had expected.
This higher rate environment has created a mountain of distressed debt.
Distressed debt is generally bonds. They are tradable. Bonds that originally sold for $100 are selling for $20 or $15 or $5.
There's more than $200 billion of distressed debt in the U.S., and that's more than the GDP of some European countries.
Since 2021, this sort of debt, owed by riskier, less creditworthy businesses, has jumped around 400%. Retailers are especially vulnerable. Inflation keeps their costs high, even as consumer spending slows. By mid-2023, the consumer industry accounted for more than a 1/5 of bankruptcy filings.
Most bankruptcies don't occur because you have a business and it loses money. A business borrows money. Times get tough. And when it goes to refinance that loan, the bank says, you're not as good a credit as you used to be, or we don't have as much money to lend as we used to have, or our standards are higher.
The hope in bankruptcy is that the doors are kept open, everyone is kept employed, but we're seeing more and more liquidations, which basically means that all of the stores need to be shut down.
For consumer-facing companies and those upstream supplying them, that will impact their businesses.
So you can kind of have this domino effect, and that can have huge impacts on communities.
And those can be pretty difficult, particularly if they have a lot of space.
Retailers use bankruptcy to get out of leases without having to pay large sums of money to the landlords.
Which leads us to commercial real estate. Remote work plus online shopping have helped increase vacancies. Unlike home loans, commercial real estate mortgages typically range from 5 to 15 years. And across the United States, almost $1.5 trillion worth of commercial real estate debt is due before 2025.
We're already starting to see some major real estate firms default on their buildings. The big impact for cities is the downtown central business districts.
Another potential victim of mounting debt is healthcare, one of the most distressed industries in the U.S., in part because the sector's relative stability made it so attractive to private equity.
Private equity goes in and buys these companies with debt, in part because they don't have to put up their own cash for it. They can basically transfer the debt to the company, but as a result, the company needs to be making enough profit, not just to pay off that debt, but also to have enough returns and lucrative returns for those investors.
As of 2023, private equity owned 30% of the country's for-profit hospitals, which means these hospitals are forced to prioritize achieving sustainable profits instead of just focusing on community needs and public health. The tech industry has its own pressures, mainly because most startups are unprofitable and depend on cheap financing.
The appetite for risk has declined a bit. There's less capital available to companies, particularly those that are growing.
Higher rates make these new tech companies less attractive because investors want to see proof of profits immediately. Big companies respond by cutting jobs to reduce costs. Small companies struggle to raise funding.
Typically, when a tech company goes bankrupt, it's a product failure. It's a technology or an idea failure. You know, it just kind of goes poof.
Playing into the consolidation of tech and some other industries is the collapse of local lenders like Silicon Valley Bank, Signature, and First Republic. All were seized by the FDIC and had their assets sold off and their demise reduced to credit availability.
A daily battle is being waged in supermarkets all over this country.
From the post-war economic boom in the 1950s to its high point in the 80s, interest rates have always fluctuated with the times. But the near-zero rates of the last 15 years following the great financial crisis have hardly been the norm.
The financial crisis was obviously unique in and of itself. This time around, banks are much healthier.
When it's difficult to raise money, clearly many more companies are going to founder.
Fortunately for companies on the brink, this time the fall doesn't seem quite so far.
It's definitely not as dire as 2008. It's not even on the same scale.
The problem is, when companies aren't put off by higher rates and keep borrowing, it may be a sign that the Fed still has more work to do to bring down inflation, which increases the odds that someone will get caught off sides and left to take the hit.
All right, that was Shonali Basak with a fascinating report on kind of what we're seeing in some of the bankruptcies in the banking space and just credit in general. You know, I think a lot of folks probably felt like we would see more bankruptcies, a lot more than what we've seen, and more as the interest rates went up by over 500 basis points. You'd see more pain maybe at the corporate level that maybe we haven't. So maybe some of that stimulus money that was on the early part of the financial crisis was there to help. That's even true in the municipal bond market. Very strong, very few credit problems there. So that is certainly interesting to see. But again, we'll see what happens in 2024. I still think this Apple news is pretty interesting here. I mean, Apple Watch sales ban is put on hold by U.S. appeals court. I kind of thought something like that would happen because it's Apple after all, but I mean, it's very rare that they make a big misstep there. So we're going to have to see how that plays out. But Mark Gurman's going to join us. Mark Gurman, Bloomberg News. He's based out in LA, and he is the go-to person on Apple. I think he just pitches a tent outside the Apple HQ because he gets all the scoops.
I think he's got his sources all over the place when it comes to Apple. But you're right, Apple a little bit under pressure, but not much at the moment. I mean, the context is, of course, that they don't make that much money from an Apple Watch. But what is the consumer implication? What do we start to think about more broadly, Apple's own technology and ability to build it in-house? We're going to discuss with him how they've just won a court ruling temporarily pausing that sales ban on their watches. This is Bloomberg. In broad context, the tech stocks are doing very little of anything today from a benchmark perspective. NASDAQ basically trading flat on the day. But there are individual idiosyncratic bits of news that we want to keep you up to date with. Apple, I mean, down just a touch on the day. We've seen, of course, the behemoth that is worth in the trillions is actually off by less than a point at the moment, less than 0.1%. But we do want to talk about the intricacies of the watch ban. Now, remember, of course, this all goes back to patent dispute with one Massimo. Now, Apple has just won a court ruling temporarily pausing the US sales ban on its newest smartwatches. So basically, the company's got a bit of a reprieve in its patent fight. And, well, had we anticipated it? Let's get to the person in the know, the one Mark Gurman, who's got plenty of scoops we actually want to dive into when it comes to the creation of new technology. But first, let's go there with Apple. And were you anticipating that they would get the stay of execution when it came to the ban?
Yes. So on December 26th, the day after the ban actually came into place on Christmas Day, Apple was able to file an emergency motion to appeals courts in Washington to get this ban temporarily stayed. Now, this temporary stay is going to last until January 10th at minimum. So they're going to get an extra 2 weeks of sales thanks to this stay that they otherwise would not have. This was anticipated. Apple made a fairly good argument. They showed in previous cases where injunctions had been in place how this same court did grant temporary stay. So yes, it was pretty clear to me, and I think a few others, that this would happen, and it indeed happened this morning. We're still waiting to hear back from Apple to see if they're putting the watch back on sale immediately, if it'll be later today or tomorrow. It's a pretty arduous process operationally to get the thing on the online store, remove it from the online store, get them back in retail stores, get them out of retail stores. So we're going to have to just wait and see how long they're going to play this cat and mouse game for.
Hey, Mark, is there any reason to believe the parties here, Apple and Massimo, can come to some kind of settlement here, monetary settlement?
Yeah, at this point, given that Apple is having some success in the legal proceedings here, I think that makes a settlement more and more unlikely. You can see Massimo's stock fell as much as over 6% this morning. I think some people who bought Massimo stock banking on additional long-term revenue from Apple are starting to realize that's simply not going to happen. And so certainly, I think, like I said, a settlement is less and less likely. They're going to get this temporary stay, and our understanding of a temporary stay from this appeals court is that this court would not have given a temporary stay if they didn't ultimately believe that this issue was going to be resolved somewhat in the near future. Now, January 10th, mark your calendar for that. That's the next hearing for the ITC to respond to this temporary stay. After that is January 12th. That's when the U.S. Customs Agency, which also has the ability to reverse the ban and allow imports of the Apple Watch into the United States, they're going to determine whether or not Apple's software fix that it developed is sufficient to no longer infringe Massimo's patents. So we're sort of coming up on 2 weeks away from this either exploding into Apple getting the watch rebanned or the ban being a thing of the past.
Just going back to the history of all of this, you've got a great piece out talking about how this whole saga was set in motion by a late night email to Tim Cook. I think it was 1 a.m. back in 2013. He got an email from, then was the scientist over at Massimo's sister company talking about sort of the irresistibility of a new wave of technology that ultimately was sort of the oxygen reader that has been in dispute here. What do you think, if anything, Massimo's ultimately going to be able to prove? Because it looks as though they failed in the court previously, but it is the ITC that's come to its salvation.
That's exactly right. I couldn't have said it better. They did fail in the court. It was a hung jury. The jury voted in favor of Apple 6-1. And in fact, this Marcelo Lamego, and this is a crazy story. For those who haven't read the article, I encourage you to do so. He writes an email at 12:53 a.m. to Tim Cook, saying that he knows how to build blood oxygen, he knows how to build health sensors, he knows how to make this technology work. Let me come to Apple, join your team, and make this happen. 10 hours later, he gets an email from an Apple recruiter. Weeks later, he's already working on Apple. He only somehow lasts at Apple 6 months, right? And then he creates his own wearables company, falls off the face of the earth. Massimo sued his company, his follow-up company, into oblivion. It's just a crazy story with this guy who's developed these health sensors, who's going from company to company. And as compelling as the email is, and you can see the email in my story, the judge threw it out and didn't even let the jury make determinations based on it. But still, I think that Massimo's gripe with this engineer and him going to Apple and their beliefs about this guy, it actually sparked this legal fight, right? A decade ago, this was the origin story, leading to the lawsuit, leading to the Apple countersuit, leading to the ITC putting this ban into place. So it's just such a fascinating story, the origin here.
Yeah, this is a great story. It got a green B, so that means it's big. It's a scoopage, which we get a lot from Mr. Gurman on a variety of topics, mostly notably Apple. But this CEO of Massimo, was Joe Chiani. He doesn't sound like he's backing down anytime soon. What can you tell us about Joe Chiani, the CEO of Massimo?
Well, he's extremely stubborn. He seems to despise Apple. He's great friends with Joe Biden. And it's very unclear what they want. On one hand, they're saying that this is not about money. This is not about a settlement. This is about, and this is to use their words, this is about Apple not using their technology for free. But them not wanting Apple to use their tech for free and them wanting a settlement, those are the same things. On the other hand, this is Massimo making a point that Apple for years has stepped on the little guys. They've, quote, Sherlocked other companies, which is the process of seeing a technology from another company, developing a competitor, and that original company going out of business. Them using a term they've called smart recruiting to hire from companies instead of acquire them. And you have seen so many companies go bankrupt over the years because of Apple. And I think Massimo's trying to take a stand here. They clearly believe that Apple is infringing on their patents, and maybe so. Maybe the solution, the fair solution here, is a licensing agreement. But it seems like Apple's decision here is to redesign some of the software underlying its blood oxygen sensor so it doesn't have to reach a settlement.
Let's just talk about smart hiring. and in the other direction? Because you've got a great story, and we'd heard in recent months that one Sam Altman was working with Johnny Ive, of course, the visionary of Apple products of old, on an AI wearable. Now, Johnny Ive has now got his own firm, Love From, and of late there's been a bit of executive turnover over at Apple, and one of the key players of product is going over to join Johnny Ive at his new company and design AI wearables, it seems. Can you tell us a bit about it, Mark?
Yeah, so Johnny Ive, who's the former head of design at Apple, and Sam Altman, obviously the embattled chief of OpenAI, they are working on a new joint venture, which is to create a slew of AI products, including AI products for the home, AI hardware. And now Apple's vice president of product design and engineering for the iPhone and the Apple Watch, he's leaving Apple in February, and he'll be heading to Love From to run hardware engineering for Love From and this joint venture between Ive and Altman. This is the biggest design-related departure from Apple since Johnny Ive, and this is the biggest hiring to date for Ive at Love From. So this is quite significant. And to your point about Apple, right? Apple is free to hire anyone they'd like, as they say, as the court said, and other companies are free to hire whoever they'd like from Apple. And this is such an interesting thing because Ting Tan, the head of phone and watch design, going over to Love from Apple, you'd think there would be some competition here. But Apple's well aware of Ting's plans and seemingly aware of Johnny Ive's plans. And they don't seem to think that the products that Ting Tan will be working on at Apple are going to be competitive in any way. And it's also interesting. I would imagine there was a 3-year plus non-compete between Johnny Ive and Apple that was into place. Well, we've passed that 3-year mark, so I'm not sure there's going to be anything litigious around this Ting Tan hiring.
All right, Mark, just a slew of great reporting today. Boy, I don't know where we'd be content-wise without Mark Gurman today. Mark Gurman, technology reporter. He is based down in L.A., breaking a lot of news on Apple. A lot of movement at Apple. The watch is in the news. Technologists are in the news. A lot of moving parts. You put it all together for Apple stock, up 49% year to date. It's got a market cap of a clean, even $3 trillion. I'm sorry, $3 trillion. How about that? Don't shortchange it. How about that? $3 trillion market cap. How about that? This is Bloomberg.